Welcome to my stock trading full course. This course is designed to take you from a beginner who's never seen a chart to a pro trader who trades confidently and knows how to set up their charts and knows the best times to trade. You're going to learn candlestick formations, pattern recognition, volume recognition, and all the other things that you need to know from what I have learned over the last 21 years. Now, this is a several-hour video and it's chaptered, and you will need to watch this several times. So there are three types of trading that you can break it down to for simplicity. Number one, probably everybody has heard of this. It's called day trading. Day trading is most popular. You're going to hear the pundits talk about it on television. You're going to hear people on X talk about it. Everybody talks about day trading. What exactly is it? Well, it's when you get into a trade and you exit that same day. Very important, that differentiates it from everything else. You enter, let's say you enter at 9:30 in the morning on the nose. You are exiting that trade by 3:59 and 59 seconds p.m. You're out of it. You cannot stay in it overnight. That's the concept behind day trading. Now, day trading can be fast. It can be 1 minute, you're in and out of a trade. 10 minutes, 2 hours, 3 hours, it varies. It depends on the type of stock that you're trading. It depends on the behavior of the stock that day. So that's day trading. The next version of trading is swing trading. You may have heard a lot of people talk about this one also. Swing trading, I say you're in a stock from 1 to 5 days. Now, can you be in it for 10 days? Absolutely. You're just going to follow the trend. But just to put it in its own little box, I say 1 to 5 days because generally that's where you're going to sit in that time frame. It's obviously longer than day trading, but it's less time than long-term trading, which I'm going to talk about next. And long-term trading is my personal favorite type of trading. And I say you're in this thing from 2 weeks to a year in some cases. I've stayed in stocks for a year, and it's just following the trend. And the beauty behind that is it's for the person that doesn't have the time to sit down and work on a chart for hours and hours a day. It is a great way of trading, great way of creating extra income. I love long-term trading. So here's kind of the trajectory of a trader, in my opinion, when you break down those three. They come in, you come in, I came in, and you start day trading because you want fast, you want action, you want to make gains fast, right? And then you realize, well, this is pretty stressful because you're on your computer all the time. So you go into swing trading and you say, this is a little slower pace and it's nice. But then you're like, I'm going to check out this long-term trading. You go to long-term trading and you're like, yeah, I really like this. Then you're probably going to create a hybrid of all three, but your bread and butter is going to come from long-term trading. That's where the majority of mine is at this point. There was a time for 3 or 4 years straight, all I did was day trade, but I can tell you, the burnout rate can be fast. Lucrative, absolutely, but the burnout rate can be fast. So now that we know the different types of trading, let's get into how to set up your chart. So I'm going to come over here. This is TradingView. I use TradingView for a couple of reasons. Number one, it's accessible to everybody. Can you have upgraded plans? Yes, I think I pay $300 a year for the specific charts that I have because I want more out of the charts. If you're a beginner person, you don't need to take that plunge right away. You can set up your charts. You can figure out what you're doing. Is there going to be a delay on your ticker symbols? Yes, but that's where you can start tailoring it to yourself to pay for the upgrade. But I like TradingView because everybody can access it day one. So we're going to come here to a blank layout. And basically what you see right now are candles, and each of these are daily candles. This is what it's going to give you right off the bat. Now, if you don't have the upgraded subscription, there's going to be, this is what your screen is going to look like. I am going to do it this way because this is what you see in my videos on a daily basis. So I have two screens. One chart here on my left is going to be my weekly or my long-term chart that I spoke about. The right is going to be my daily or my swing trading chart. Now, before I go any further, I want to make perfectly clear that the candles on each of these are the same. They're day to day. You're going to see the differences in why I have two different charts, but I want it to be very clear that we have the exact same candles on each side, meaning that this candle right here on my right is the same candle as this right here. Let me draw on here. This candle is the same as this candle. This candle right here is the same as this candle. That's very important to understand. So we want to make sure that we are on daily. You can see there's a D up here. You can change this to whatever you want. You could change it to ticks if you wanted to, but I keep it on 1 day for right now. Now, let's start with the swing trading chart. It's a little bit more in depth. I'm going to just blow up the daily chart, okay? So we come down to indicators and we search. The beautiful thing about this is that there are so many indicators. If we just click technicals, look at this list. you can just continuously scroll and scroll. You can go through different financials if you want. And then the community, this is where it gets interesting. People can upload their personal patterns or chart setups or what have you. You can get very, very into the weeds in TradingView, much more than other platforms out there. So I'm going to come up here and I'm just going to click my first one. So if I'm just going to search this for everybody so they can see SMA Veda. So Veda is the person, I don't know who this is, but I like theirs a lot. I think that they do a great job with moving averages. Now, moving averages are, let me get these up here first of all, and then we can start changing things around. Moving averages are just what they sound like. It's the stock price's average movement over some days period. I personally use the 25, the 50, the 100, and the 200-day moving average. You might have people out there that talk about the 1,000-day moving average, the 10-day moving average, the 250, 365-day moving average, 1 year, whatever it is. I have found that I really like 25, 50, 100, and 200. So to edit this, I like to come up here, and now that we have the indicator up, you click on the settings button. And you can come through here, and it takes a little bit of time, but it's really not that much time. And I like to make it a line. I like to put it on the second one. My second indicator, I like to put it on yellow. This is going to be my 50-day moving average, so we'll get that one set up. We go to our turquoise, which is my 100-day moving average, which will change some numbers in a second. White is my 200-day moving average, and you can see I like changing the opacity up to 100. I like making the thickness a little bit smaller. Now you go to inputs. This is where we can change what the chart actually looks like. So we're going to go with 25, 50, 100, and 200, and we're going to source it all on the close. Click, and boom. So you might notice here that you can't see the white line that I just drew. I personally like to have a black background. I think it looks better. It's easier on the eyes. So you come over here to settings. You come here to solid. You know it's solid. You go to black, and now you can see everything. And this just makes things a lot easier, in my opinion, when you start trading on a consistent basis. So we have this in black. Now, we also want to add the stochastic. And you're probably hearing this word for the first time, and you're saying, what in the hell is a stochastic? It is the trend. You're going to hear me say trend more than you're going to hear me say stochastic. The trend is everything when it comes to trading. I can guarantee you that. If you don't have a trend with you, and you're just following the price moving up and down, it's not going to work for you in the long run. So let's come up here, and you can see I'm just going to type in stochastic, and it's very easy. You go to the first one on technicals. I have it favorited. It's just stochastic. You pull it up. Now, we're going to go and edit this. So come over here, click on the settings button. This is where you start changing some settings. Just like we changed the moving average numbers, I have found that creating a smoothing mechanism or smoothing numbers of 1033 is one of the best trend lines that you can find when it comes to swing trading. So, and then you need to make sure that you put this on 1 day. I know that a lot of people, this defaults back to chart. You need to make sure that you have it on 1 day. This is very important, or your chart is going to look very different from mine. Then you come over to the style, and I like having a red %K. I like having a yellow %D. And then my upper bands, I don't like having a middle band. I think it's useless. And I like having a lower band here, like having my lower band set at 32. You're going to hear me talk about the sweet spot. Between 32% and 80% is the sweet spot, where you have the probability to make the most money. And don't get discouraged with me saying these things like where the sweet spot is. We're going to get into that later in the video, but I just want to give you context of what I'm doing here when I'm setting up my chart. You'll remember this portion later in the video. 32% on the bottom, and I like to have them smooth. And if you want to replicate your charts exactly to mine, you're just going to go and have them smooth, make it black, make it dark black, and there we have our stochastic or trend set up on the bottom. Now, one more thing that we add to this chart that you might look at this and say, this is a lot. I can promise you, if you go to other people and watch them trade, they're going to have a lot more on their screen than this. Really, if you're looking at this, we have candles. That's the basics of every chart. Everybody has candles. I have a moving average, I have a trend, and I have one more thing. I have 3 indicators on this thing, which is absolutely nothing. When we go to the other chart, it's only 1 indicator. So you're going to come here, and you're going to type in volume. Volume, just go to volume, and you're going to pull up the volume. What is the volume? The volume is the gasoline that goes in the car. The volume is the gasoline to the market. If you don't have volume, stocks are not going to go anywhere. This tells you how much is being bought or sold in any given day. So we're going to come up here to volume. We're going to click on our settings indicator. I like having the volume moving average up there. It tells me the average volume of the market, or the average volume of the market or that specific stock over a 30-day period. So I like going here to inputs, and I like changing this to 30 days. Just kind of gives me a roundabout month. You can see on JP Morgan, you see how these green and red bars have not really touched. You see these black gaps in here? Well, these black gaps indicate that we did not hit average volume in that time frame. And if you take a peek over here, 1.74 million as of right now at 10:23 in the morning on a Wednesday, and the average volume is 8.8. So you can kind of gauge, are you going to get average volume that day? We'll get into that later in the video. And that is my chart setup for swing trading. It's very, very straightforward. There's not a lot to it. Now, let's go over here. This is my long-term chart. This one has one indicator, and it's the same thing, stochastic. You're gonna notice I don't use any moving averages here. You're gonna notice I don't use any volume on this chart. You don't really need it on this chart. Plus, you have it on your other chart. So let's put stochastic here, and the difference over here, let's drag over, let's go to settings, is going to be 19.44. And you may say, how do you come up with these numbers? Well, we've done a lot of testing on this. We figured it out. It took a long time to figure out. We got it. Just trust me on this one. Let's go to 1 week. Why do we put a week? Well, we put a week because we are looking at the trend over a long period of time. Now, on the other chart, you notice we put 1 day. And I'm going to show you a comparison after I set up the colors here. And you're going to see the major difference of why we have those two charts and why I have those charts side by side. So if we go here to style, let's just change this to red. Let's change this to yellow. Let's get rid of the middle band as we did. Upper band is going to be 80%. Let's make it solid. Lower band is going to go 32%. We're going to make that solid. And let's change the background to black. And there we go. Our chart is set up. Very, very simple. Now, I'm going to pull up the comparison of the two. Remember, guys, we're looking at the exact same time frames on these charts. This cluster of candles is the same as this cluster of candles. What do you notice down here? You notice, and let's circle it, if we just go and draw this straight line from here to here and there, let's go from here to here. What do you notice? Well, this stochastic this trend really didn't do anything. This one was crazy wonky. That's because this is set to 1 day. It tracks the day-to-day movement, the day-to-day trend. This tracks 1 week. You're obviously not going to have a lot of movement over a 1 week time frame when it's averaged out versus a 1 day time frame. So this is how you set up your day trading, your swing trading chart and your long-term chart. I'm getting ahead of myself. The next one we'll go to is the day trading chart and how to set that up. So let's head over to our day trading chart. Now, when we talk about day trading, it's a little bit different. It's different in that these candles that I'm showing you here are each a 15-minute period. And if you come up here and look right up here where I'm circling, it's 15 minutes. It's not 1 day candles. It's not 1 week candles. It's not anything. It's 15-minute candles. What does that mean? Well, I like thinking about it this way. Let's use yesterday, for example. I'm going to go to Lockheed. I'm going to go to JP Morgan because that's what's on our other screen. And let's pull up this and let's go here and let's blow this up. And we're just going to zoom in on this one specific candle. We're going to zoom in on yesterday because the day was complete. So let's look at yesterday. This candle right here. That's what we're focusing on. And now we're going to take a magnifying glass and zoom in on this candle that I just put an arrow on and go here. This was yesterday. And you can see the stock price ran up and then it pulled back down. You can see that from that long wick up there, right? The stock price ran up and it pulled back down. And if we look here, the stock price ran up and it pulled back down. And that's the idea behind a 15-minute candle. So we can, over here, we wouldn't know to trade that movement. How are you supposed to do that? Just guessing where the stock price is going to go? Over here, you can actually see it. So each one of these candles, this is 9:30 in the morning, 9:30 in the morning, 9:45, 10 o'clock, 10:15, 10:30, 10:45, etc., all throughout the day. This is the chart where you need to enter during the day and get out during that same day. So how do you set up this chart? Well, let's look at it. It's very, very simple. We want to make sure we're on 15-minute candles. We go to indicator, and we're going to bring in our stochastic again. We need to have our stochastic again. And this one is very simple. It's back to the same old 10-3-3, same as the daily chart, right? And now we want to have this on 15 minutes. Style, I like to have the same thing. I like consistently across things. If you stay and watch this channel for any length of time, I am always going to have consistency and simplicity across everything. I am big of the mindset, keep it simple, stupid. Now, there's another difference on this chart. I'm just changing the colors. Another difference on this chart. Notice our sweet spot, 80 and 20. I'm not changing it. The idea behind this chart is our sweet spot is not in between. It's not here like it was on the other charts. It's actually above. We want to be above 80% when we're going long and below 20% when we're going short. We'll get into that later in the video. You don't need to worry about that right now. But I want you to notice that I do have these differences here on purpose. I'm not missing something right now. So I'm going to go in. I'm going to press OK. I'm also going to throw volume up there because the volume is incredibly important when it comes to this chart. I'm going to star this so it's always up here. Volume. And let's go in and change this real quick. Let's put in moving average of 30, just like we did before. Let's go to style. Let's add this, change it to yellow, and there we go. We have our average volume. And there, my friends, is your chart setup. Really not that hard. You have at most 3 indicators on a chart. The other 2, you have 2 indicators. It's very, very simple. Remember, everything about this is keep it simple, stupid. It's not simple at first, but it becomes simple with repetition. And the more simple you can make it, the better I believe you're going to be as a trader. So now that we have our chart set up, let's start getting into what is exactly on these charts. And the first thing I'm going to start with, just like we did when setting up the chart, I'm going to start with candles. So when you're looking at candles here, you notice that they kind of move all over the place. You have big ones, you have small ones, you have long wicks on some. Let's get into and let's start drawing some different candles that you're going to see. So I'm going to pull up the long-term chart here, and I'm going to move it all the way to the side just so I have a blank black screen, and I'm going to start drawing here. So when the most common candle you're going to see on any chart is called a doji. And what is exactly a doji? It's basically a candle that doesn't have a lot of movement during the day. It's going to kind of look like this. It could look like this, but you're really just going to have some movement that went up, some movement that went down, and it kind of closed around where the day started. So if we pull this over and we start looking in here, in this little channel of you can see the stock price didn't really move. It went up a little, came down a little on multiple days, but you didn't really have a lot of movement. So you kind of had a doji candle here. You kind of had a doji candle here. They're really boring days. You might sometimes open your Apple Stocks app and you'll be like, man, nothing's really going on today. That's going to be basically your doji candles that really don't do anything. And we don't want to do anything on those days. We don't want to do anything on days where there's not a lot of activity. So recognize that you're going to see candles like this. They could be different shapes. They could be something like this, maybe something like that. There's really not a lot going on. Okay. The second type of candle we're going to look at is your candle with big wicks on them. These are days where you just have a lot of volatility. So you can have something like this. Notice your doji is small. There's really not a lot going on, but you can have a big wicked candle. Now, typically when you get candles with big wicks on them to one side or the other side, you're going to have a change in direction. Why? Because it really is going to go into saying there's not a lot of agreement. Think about this. This is a market. And if you're in a market and everybody's pushing in the same direction, well, something's going to go up, right? Like this day right here, everybody was pushing for the stock price to go up. This day right here, everybody was pushing for the stock price to go down. But if you have a day where, let's see if we can find one here. Here's two examples. There's one right here. You have a day where the stock price ran up in the morning and it pulled all the way back down, and then it kind of stopped and closed right in the middle where the day started, right? This one right here. You started the day right here, you ran up, you came all the way down, you kind of concluded right here. There's really not a lot of agreement or consensus of where that stock price is going. And usually when you see that, when you see a big wicks on both sides, it's hard to say 10 times fast, you're going to see a change in direction. You're going to see a change in direction. If you saw this going the other way, it would be a change in direction to the other side. You're typically going to see that change in direction. Look at this. You have that change in direction. That's the beauty of being able to identify candles with big wicks on them. Now, there's other candles that you can see that I call hammers. So hammers look like, really, a hammer. So if you look at a hammer, it kind of looks like this. And the idea behind it is that you kind of open the day up here. This was your open, and the stock price fell all the way back down. But what did it do? It had that volatility, and it came all the way back up, and you kind of closed the day right where you opened, so you had your close at the same point. So when you see hammers, you're typically going to see a change in direction. Let's go and see if we can find some here. So here I actually used this as a big wick one earlier, but you can kind of see it was a hammer formation. Not your ideal, but you had that change in direction. Here, you had a little bit of a pullback and you change in direction. Now I want to point something out. I want to point out that there were two hammers right in here, and you could tell that the direction didn't change. I need everybody to understand that trading is based off of probability. It's a probability that something is going to happen. So when you get a hammer formation or you get any type of formation, any pattern, it's not always going to happen. There's a higher probability that it does happen. That's the idea behind this. So if you are looking at a stock and not everything's aligning for you as far as the trade goes, and you all of a sudden, just say you get a hammer formation, you're like, most of this is going to change in direction. No, it doesn't always happen that way. It's usually if other things are aligning to it and saying, okay, everything's kind of going my direction. Here's an example. This thing went up, it kind of came down, and then you can see the hammer formation started here, and it went like that the next day. So just understand that changes in direction happen when hammer formations are formed. Now you also have inverse hammers. Inverse hammers are exactly the opposite. They're stocks that start the day on the bottom. Here's your open. It runs up. It pulls all the way back down. It closes back down here. And you're going to get a change in direction to the other side. And that is exactly what you're going to look for with inverse hammers. Now, when do you buy a stock? That's the real question. What kind of candle do you need to buy a stock? Well, you need an engulfing candle. So I'm going to draw a couple of dojis here. Let's just say that we had a couple of dojis. And let's give a little bit of this one day, and then all of a sudden the next day you get that. It's a thick candlestick that is filled. There's no wicks on it. That is an engulfing candle. This, for example, is an engulfing candlestick. This, for example, even though there's a little wick on the top, is an engulfing candlestick. Let's just continue on. This here is not an engulfing candlestick. Why? You need an engulfing candlestick to go this way on you. This needs to be, it's green. I should use blue here. It's green. It goes like this. So it's the right color, but it's not taking out the high of the previous day. This right here, this candle right here, this is an engulfing candlestick to the downside. You always want to be buying or selling short on engulfing candlesticks. Today, honestly, on JP Morgan, this is actually a pretty nice engulfing candlestick to the downside. Now, I would like to see this. You notice how we're starting to get this wick on the bottom? That means that the stock price is pulling back on us. I like to see a candle that is more like this. And you probably say, well, it was like that at one point. Yeah, if the volume was with it, and we'll talk about how to enter trades later, but if the volume was with it, that's where we would be entering the trade, on the low of the day when it comes to shorting, or on the high of the day when going long. So these are your different types of candlesticks that you need to study and be familiar with. And the best way to do this is pull up a chart and zoom back as far as you want and start going through and saying, okay, what do we have here? Let's see. Engulfing candlestick right here. Engulfing candlestick the following day. Engulfing candlestick here. Doji here, we're not going to do anything. Doji here. Kind of engulfing, but not really, because it didn't take out a previous high. This is just nothing. Here's a big wick. Here's a hammer formation, and what happened with the hammer after being up here at the same price for 3 days in a row, you started to fall down. Here's another hammer formation. What happened? Stock price went up on you. These are the things. Here's a inverse hammer formation. What happened? Stock price dropped on you. I would say go to your next stock, go to Apple, and just keep practicing and seeing these things over and over. Engulfing candlestick, engulfing candlestick. Doji doesn't mean anything. Inverse hammer formation, change in direction. Hammer formation, change in direction. These are the types of things you need to practice, because this is all about repetition. And you can do this on any chart. except for, I shouldn't say that on any chart. You should do this on your swing trading chart or your long-term chart because the candles are different and everything about day trading is kind of different. So I want you guys to focus when it comes to identifying candles, except for engulfings. You need engulfings on a day trading chart, but you need to be able to identify what is an engulfing candlestick, what does an inverse hammer look like, etc., before you get any further. All right, so we talked a lot about volume. Let's go to JP Morgan because we were just talking about that one. And let's pull up our daily chart because that's where you see the volume. Why don't I have the volume over here on the long-term chart? Because I don't need it. You'll see when I start talking about a long-term chart why I don't need volume over here. It's really not important day to day because I am in this thing for 2 weeks to 1 year. I don't care about daily volume. You're going to have good days of volume, you're going to have bad days of volume. But when it comes to a swing trading chart, you need to have volume there. Volume is very important because it's a quick 1 to 5 day trade. You need to make sure you're getting good volume in there so you don't get a change in direction and get burnt. Okay, so let's look at volume. What is volume here? I like to look at it this way. You have a hill, and you have a boulder here at the bottom of this hill, and you have one person down here that is trying to push this boulder up this hill. It's going to be very, very difficult to do that. Why? Because it's an incredibly heavy item. That's how it is with a stock price, getting a stock price to go to a new high. You can actually see here, if we just draw a line here, look at that. You had the stock price of JP Morgan jump one day, and it fell back down and it tried to get through, it tried to climb up that hill and it tried to break through that high. And what's it doing? It's falling right back down. It doesn't have enough volume. You would need to see multiple days of green. So this would have had to be green, this would have had to be green, this would have had to be more green all the way up here. This would have had to be, we need today more green. All of that green buying volume for multiple days in a row for this thing to push through these highs because you're trying to push that boulder up that hill. Now, let's say that we get this. We get all of this green volume that I drew in here. Would it be able to push here? Yeah. Why? Because you have all of these people down here helping push this boulder up this hill. And that is how volume works. Volume is a bunch of people at the bottom of the hill pushing in one direction, and then this boulder is going to go up this hill. That's how the stock price is going to go up. Think about it if you have, another example is a car. If you don't have any gas in your car, you're not going to be able to drive up a hill. It's just not going to happen. You're going to run out of gas and you're going to slide back down the hill. If you have a full tank of gas, you're more likely to get up the hill and not slide back down because you have all of those chemical particles that are pushing up the hill. Think of it as the same people in that pushing that boulder up that hill. Volume is so important to the market. If you don't have volume, forget about it. Today, for example, you know how I said in the last, when we were looking at the candles, if we had something like this, if I saw that it was filled at one point, like we just said, that wick was not there, but the volume is no bueno. We don't like that volume. I want to see more volume coming into this thing, staying at the bottom of the candle. And if your thickness stays at the bottom of the candle and you don't get a pullback on the wick, that means that there's a lot of volume in there pushing that thing down or up if you're going the opposite direction. Now that we have the volume under control, let's get into the trend. You're going to hear me say this a million times, and I'm going to say it a million times again. The trend is your friend. The trend is your friend. If you trust the trend, you will do very, very well in trading. If you deviate from the trend and you just follow price action per se, it's not going to work well for you. You have to follow the trend, and I'm going to show you why here. So there's a couple of different trends that we're going to see, and we're going to talk about them in different ways. So we have the trend, obviously, on this chart. We have the trend on this chart. We have the trend on the 15-minute chart. It's the only thing that we have on every chart, right? There's a reason for that. It's very important. So let's start over here with the daily and the weekly. So if we look at the trend, let's think about the sweet spot first. Let's move this out of the way. This area between here, when it comes to the daily and the weekly, is the sweet spot. We want to give ourselves the best opportunity for things to work and the best opportunity to make money. So let's look over here, and that's where the sweet spot is. So the sweet spot, this is our 80% line up here, and this is our 32% line down here, 80% up here, 32% down here, and this is the sweet spot. We always buy or short stocks when we are in the sweet spot. So if your stochastic, for example, is, let's talk about the daily real quick. If our stochastic is, let's say, up Today is actually a good example but yesterday, for example, 2 days ago on JP Morgan, up in here. No, we're not executing a trade. We are executing a trade when our trend lines, both red and yellow, are in the sweet spot. That's our stochastic settings over here that we talked about earlier in the video. You need to have red and yellow in the sweet spot. Now, it's not just red and yellow being in the sweet spot. You got to have volume with you. You got to have engulfing candlesticks. We have to talk about resistance, support, etc. But you need to be able to have your red and yellow in the sweet spot. So when we come over here to the other chart, let's go to our long-term chart. We want to have red and yellow in the sweet spot. Red and yellow, ideally coming down, going short in the sweet spot. And I want to show you guys something else. Let's go to Google. This is a great example. And I'm going to go back a couple of years here on Google because this was a great example of how you can stay in a stock for a very, very long period of time. So if you looked at this, Google came down. All of a sudden, Google started to creep back up. It was in the sweet spot. Red and yellow are in the sweet spot for 3 days. We want to be in the sweet spot for 3 days when it comes to the long-term chart. Why? Because things can change so quickly on the long-term, or things can change initially so quickly on the long-term chart. Not over a long period of time, but in the beginning of a trade, they can change very quickly. So let's look at this. We were coming here in through the sweet spot. We were in it for 3 days, right? We got our 3 days. Let's assume that volume was very good. We got our engulfing candlesticks. You can see them here. You can see them right in here. One of those was an engulfing candlestick. We entered the trade. Now let's just stay in it. When people get into this area up here, this is what I call the overbought area, over 80%. People will say, okay, trade's over, I can exit the trade. No, this is where you can make the most money. Because what happens when a trade, we don't want to enter up here for the first time. We want to enter down here. We want the run to be with us. We don't want to enter up here for the first time, but when our stock gets up in here after going through the sweet spot, we stay in it. And what happens when you go like this and you go sideways, sideways, sideways? What happens? Well, you entered back in here, and this is kind of the point where we got and started to go sideways. And as you go sideways, what happens to the stock price? It goes up, up, up. Again, here, entered back in here, entered on your engulfing candlestick, got to the top, go sideways. What happened? Stock price goes up. Now, let's go on the contrary, because you're probably asking, well, what about the opposite of that? Well, when we are here and we're in the overbought area and the stock price is going up, 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 all of a sudden, what happens? We start to come down. All stocks ebb and flow, even stocks like Google. Don't think that stocks go up forever. My shirt says stocks only go up. It's not true. It's a funny saying because it does seem like the market never comes down, but stocks always come down, including things like Google. And what happens when they start coming down? Look, as you get into this oversold area, you can see the stock price just continues to fall, continues to fall, continues to fall. That is the importance of trend. So we like to enter stocks in the sweet spot on both charts, on the daily and the weekly. And we like to trust the now, I want to talk about snapbacks real quick. So if we come here and we look at Adobe, for example, ADBE, I think this is a good example right now. We look at this, and this is somebody in our community that was in the stock. So I'm going to pull these charts up side by side. Notice here, we were in the sweet spot for 3 days. You got an engulfing candlestick somewhere back in here. Let's maybe call it right here. Maybe it was in here. I don't know exactly where he entered. But look, stock price fell from 530, 540 down to 470, right? And what did the trend do? Well, the trend is still down. But what happened to the chart? What happened over here? You actually had a very big, what's called a snapback, where the stock snapbacks in price. They went from making all of this money to kind of giving back all this money if they didn't take profits. Now, they did take profits, but they could have given it all back. But why did they stay in the trade? Why did they stay in this trade? Because the trend didn't change. So, and you can see after it hit this kind of resistance point, which is that boulder, needed the volume to push through. Look, it's coming all the way back down. This is going to fill this gap. It's going to come back down, and it's probably going to go lower than here. You have to have the wherewithal and the experience to say, well, the volume is actually pretty terrible for this entire snapback, so the stock price is going to fall back down. I need to be able to stay in this thing and trust the trend. Trusting the trend is so incredibly important. If you don't trust the trend, you're not going to do well in trading. So trend is everything. Trust it, and you will do very well. If we come over here to the day trading chart, it's a little bit different. Remember, we drew these lines, 80% on the top, 20% on the bottom. This area in the middle, I call no man's land. It's not the sweet spot, it's no man's land, okay? The sweet spots are up here, above 80, and down here, below 20. So if we're looking, let's see if we can find something on JP Morgan. Let's see if we can find something. Nothing there. Oh, okay, so right here. You have a stock that broke down in the morning, broke down later in the morning, and you finally got an engulfing candlestick around here, about 10 o'clock. And where were you? You were down here below 20%. That is your sweet spot. That's where you execute the trade. The volume, as you notice, in each 15-minute period was increasing, right? You were increasing in volume, meaning that there was more consensus coming that there were sellers in JP Morgan at this moment in time. So you got your engulfing candlestick, you sell short, you stick with it until the volume changes, until the trend changes on you, and you exit. And that is how you use the 15-minute chart. You go sweet spot below 20% when you're shorting and over 80% when you're going long. Now let's talk about consolidation, support, moving averages, resistance. So if I'm going to go over back to my daily chart, because this is where you can really see it. And I'm actually going to go back to JP Morgan. This was a great example of a consolidation channel. And if we go, so let's look at this consolidation channel. What exactly, let's start with consolidation. What is it? Consolidation is, I'm going to put it in very layman's terms, when you get to an area where you really can't break through one way or the other. You kind of, I call it being range bound. This is range bound. So your stock price, for example, you can see it climbed up here and all of a sudden it hit in this area and we just kind of got stuck. Now, why did we get stuck? Oftentimes, if I just draw a box around here, I'm going to draw a box around here, and I'm going to go straight down, and look at this. You didn't hit average volume for many, many, many days in a row. Therefore, you're stuck in a consolidation channel. It's people just buying, selling, buying, selling, buying, selling. There's no consensus. Each day it just pushes up. Now, here we had a big jump in price. This day that was Wednesday, November 6th. So election was over, stock price jumped. You came up here, and now look at this. You are just stuck. You're in another consolidation channel. Now, you had a big buying volume day, lots of selling volume days, and now look at the last 5 or 6 days, just back and forth. You had buying volume, selling volume, buying volume, selling volume, buying volume, today's selling volume. And that means that you're just going to be stuck in a consolidation channel. So when you're in consolidation channels, basically, what are they for? What do they mean? To me as a trader, they mean two things. One, you can't really go long over here because you're just stuck in a channel. You need something to break it out. But if you are swing trading, you know where your exits are and you know where your entries are. Because this, to me, is telling me, okay, let's draw a pretty concise line up here. There's our top and here's our bottom, right? So now I know if I go long on something and I'm going to buy a stock to go long, I know that I need to exit at this yellow line that I drew, which is about, I don't know, call it 226.50. And if I'm coming down, I need to know that I need to exit around 220. It's very simple. So that's the beauty of these consolidation channels. They give you points of entry and exit. Now, how are the consolidation channels formed on the top and the bottom? That's where resistance and support come into play. What pushes you through resistance and support? What is resistance and support first? So I look at it saying it's steel I-beams. If you're looking and you put a steel I-beam up and you fixate it to two pieces of concrete and you try to push through, to go directly through the steel I-beam, you're not going to be able to. This is how they build buildings. You're not going to be able to get through it. It's going to have a huge level of support. Now, is it possible that you can get through it? Yeah, you might need a bazooka or something, but if you have a ton of volume, that's basically your bazooka. That's how you break through those resistance and support levels. They are breakable. You can absolutely attain breaking through it, but you need to have that bazooka. You need to have a lot of volume on your side that pushes you through it. So if we just zoom this out, actually, you know what? I'm going to go over here to Zim. Zim is a great example of a support level that cannot really be broken. So if we come here and we zoom this out, and I'm going to go all the way back to 2018, I believe it was. Or was it 2020? 2021. You have kind of here, and if we just draw that straight line across, you notice there's a consolidation channel there, and you notice this peak that your stock price ran up and it fell, and if we just keep going across, you kind of see came up, fell down, came up, fell down, came up, fell down, came up, fell down, came up, fell down. And I just keep saying it over and over. It's the steel I-beam that it cannot break through. And this goes back years. This goes back about 5 years that it cannot break through this level, 3 years. Today, we kind of broke through that level. We're going to see what's going to happen. It was a result of earnings that jumped this thing up. But will it be able to break through this level right here? Stocks can always get through the level, but can they maintain staying above that level? You notice here a couple of months ago, it jumped through that level. And what happened? It fell right back down. Same thing. Jumped through that level, fell back down. Jumped through the level, fell back down. We're going to see if, to me, this volume right here is not enough to stay above this level. I think it's going to come back below this steel I-beam that is being created. That's resistance. And support is just the opposite. It's on this side. It's the same thing coming down. It kind of hits that support level, bounces back up. Hits the support level, bounces back up. I encourage all of you to go through a lot of different charts and zoom out and see if you can draw in different levels of resistance and support. You see me often. I will go, let me pull up my long-term chart. This is what I like to do to practice. I like to zoom it out and get some lines drawn. Okay, there's a resistance point. Now let's go and find another resistance point. I'm going to start here. I'm going to go across. Now, what do you notice here? You notice that we had a little channel in here. We had a big drop in price here. We had consolidation here. You actually had a big peak of one day and a big trough of one day. You had a lot of consolidation here. And if you actually look at this V that was created. It stopped right at that I. That's another level of support. Here I see a little table. So let's draw a line across this table and see what we have. And look at that. Consolidation, consolidation, consolidation all throughout here. Consolidation all throughout here. And this is what I want you guys to do. Go in and just try to practice drawing these lines. You will get very good at it. That's how you learn to put in resistance and support. Now, moving averages. Moving averages really kind of draw them in for you. So if we look at something like, let's go. Let me see if I think Apple is a good example. Yeah, Apple is a good example. So again, our moving averages, purple, 25, yellow is 50, turquoise or blue is our 100-day moving average, and the 200-day moving average is white. Apple tends to follow the 25-day moving average for whatever reason. So if we look back in this time frame, you kind of run up, you look like you're about to fall below the 25 and you don't. And look like you're going to fall below the 25 and no. And here, you actually drop below the 25 and you go back up. Drop well below the 25 and the 50, but what do? You go back above. And you can see that Apple is just kind of stuck on its 25-day moving average. Apple loves the 25-day moving average. Probably because it's a leader in the market, it's going to be hard-pressed to drop below the 25. But these are what you can use, and if we zoom in here, you can use these moving averages as resistance support lines. Drop through, you're going to get stopped by the 100. Move up, can't get through the 50. Drop through, can't get through the 100. Come up, can't get through the 50. You do get through the 50, but you can't get through the 25. It's built-in resistance and support levels. Never buy stocks going into, if you're going long, buying them into the 100-day moving average. You're going to get knocked down if you don't have enough volume. When you're going short, don't buy it into a moving average like the 25, 50, 100, or 200. You're going to probably get bounced back up the other direction. It's very, very simple. Moving averages are very, very important, and they play a huge role in support and resistance. So now I'm going to get into a common theme that I see with especially new traders. They chase stock price. They chase price action. They don't factor in trend. They don't factor in anything else. Now, example, when we see a stock price that goes, let's use Tesla, for example. Tesla, since the election, has, actually, you know what? No, let's use Apple. Apple is a great example because it has multiple examples. I'm going to pull up here a line chart. Change it out, go to line, and you can see kind of what happens. So you notice I have these days of where we go straight up, but they have these other days where you kind of have these zigzags in there. You kind of go like this to climb, or you come like this coming down to the bottom. What I don't like to see is when a stock price just goes straight up. Why? Because typically it's going to come straight down. Now, why is that? Great question. If you have something that goes like this, just multiple days in a row, this is probably 6 to 10 days in a row, it goes straight up, it creates what I call a flagpole pattern. where I'm just going to draw a face on there. It's a flagpole. What happens with flagpoles? Well, flagpoles tend to come straight down. Why? Because there's no built-in resistance or support. So look at this one. This one is, you had these zigzags going all the way up, zigzag, zigzag, zigzag. Now what does that do? Each one of these zigzags and pulls back in price, it creates a new support level. It creates a new steel I-beam that needs to be broken through. So when the stock price runs up like this, let me use pink. When the stock price runs up like this, it's gonna pull back. We like to have pullbacks. Let me say that again. We like to have pullbacks. And some of you are probably saying, why would you want a stock price to go down? Because I look at this over the long term. If a stock price comes down and it doesn't drop below a certain support level, that means that it's gonna have more strength and more stability to continue to climb, and that's exactly what we see here. So let's say that this would have dropped through this yellow line and it would have came to right here. There's a very, very good chance that it would have bounced up and continued to go. Why? Because there was a support level that was drawn in here. So each one of these pullbacks is kind of higher than the previous one. Why? Because of the previous yellow line that I drew. Even over here, you go up, you pull back, up, pull back, up, pull back, up, pull back. These are higher highs. So you're creating these higher highs. And you notice it's harder for the stock price to fall back down even here. It stayed up. I mean, this is from October to basically mid-February, where this thing could not break through this level, this level right here. Why? Because there were so many of these support levels that were built in. There's three different types of W formations. So when you're going up, when we're going up in stock price, when we're going long, we want the stock price to go up. There's three different formations. You have your most ideal formation, like this. You have these W formations. You can see that these look like W's. You have your higher lows, right? Then you have your W's that look like this, which are really nothing. They're just kind of, it's not as strong as this. Why? Because it's not really creating that new support level in there. And then your third one kind of looks like this, and you can see that it doesn't really have any type of direction. It just bounces around. To me, this is the most important one, where your next high is lower than your previous high. This one, your next high on the right is higher than here, and your next high is even. So you have these different formations, and if we clear this out, so you have like this, and you have like this, where it's at that same kind of level, and then you have kind of this one, which is not ideal. So this is when you're going long. Now, when you're going short, it's the exact opposite. You want to see, you just flip it over. Guys, shorting, we're going to get into a whole thing on shorting in this video. You're taking the chart and you're flipping it upside down. There is nothing else to it. There's nothing else to it. You're taking the chart and reversing it upside down. It's not scary. To me, when you're coming down, you need to have M formations. Why? Because they're creating those new levels of resistance. Again, stock price comes down, you give back a little bit of your profits, it falls again, you give back a little bit of your profits, but it's gonna hit this level, and even if it does creep up and hit this level, it's gonna stop and it's gonna come back down. Why? Because you're creating those new levels of resistance. So this is your most ideal. Again, this is not your most ideal. And then the last one is when you start getting these higher highs, which you don't want to see, or these higher lows, which you don't want to see. This is your most ideal. So when we talk about M formations and W formations, this is what we're talking about. And you just pull up a line chart and you can see when you have flagpoles, what typically happens, stock price comes back down. Typically, stock price comes down. There was a time it was the craziest thing I've ever seen on Apple. Yep, it was right here. And if we pull up the candles, you can see we had from March 15th through March 29th. That is a ridiculous amount of days for a stock price to only go up. And what happened after that? Stock price only ran up, flagpole pattern, worst possible situation. It didn't. Best case scenario, the stock price falls right back down. Worst case scenario, you get M formations on the way down. Because what does that do? Well, it builds in those different resistance levels, and look how long it took for this thing to get back up here. That was from March through mid-August that it took for it to climb all the way back up. That's the power of M formations and W formations. Now let's talk about the bid-ask spread. This is a comment that I hear. Mo, every time I buy a stock, the stock just drops on me. Let's say that we're going along. It just falls right back. And I always say, well, did you pay attention to the bid-ask spread? And something common that I hear back is, what's the bid-ask spread? So let's talk about that. If you come up here and you look, there's always a buy-sell. Remember, guys, this is a market. There's somebody buying and there's somebody selling. So let's blow up this chart. Let's move it over so I can draw here. Let's think about it this way. You have a bid, and this is you who wants to buy a stock, and you have the ask. And the ask is the person that's selling you the stock. And let's say that the stock price is at $100 on the nose, okay? Well, you want to pay $100 on the nose. And if you notice, you're never going to have perfect consensus. It's never going to be they're going to sell it to you for $100 on the nose. They're going to sell it to you for $100.01, $100.02. This is where it gets interesting. The spread between the two can tell you if there's, I call it manipulation in the stock. Are they trying to get more money? So let's say that you go in, you're putting in a market order, and you want to pay $100 for something, and all of a sudden they have an ask in there of $100.30. Well, as soon as you press execute on that order, what are you going to get the stock price for? You're going to get it for $100.30 because that's the going rate. That's the ask of the market at that point in time, right? So you're going to see it in your computer. It's going to execute. You're not going to get it for 100 what you wanted it for or what the stock price was at. It's going to jump to $100.30. Maybe this is an extreme example, but I just want to show you what happens. It's going to jump and you're going to get it for $100.30, especially if it's a stock with very low volume. That's why I always like trading stocks that are 1 million shares traded or more. If you trade a stock that has 100,000 shares traded per day, very good chance you're going to get stuck with something on this. When I'm on my other side and I'm not trading and I'm investing, I will often buy pharmaceutical companies that are very small. They could be market cap of $150 million. And if I don't put in a limit order and I put in a market order, I'm going to get screwed on this. I could go in there and put in something and say, hey, I want to buy this for $1, this share for $1. But the bid ask is actually at $2, or the ask is at $2.50. And as soon as I execute for $1, it's going to give it to me at $2.50 unless I put in a limit order. Now we're using this in the broader market, and this is the same concept. Remember, it's a market. Somebody's selling it to you. So if we have our bid at 100, ask at $100.30, you execute a market order, you're going to get it for 130. And then what's going to happen? What's going to happen? The market maker is going to drop his ask price because he found a sucker to get it at $100.30. He's going to drop it to $100.10 or $100 and no cents. And then everybody's going to start to buy at those lower prices. And you, who bought it at $100.30, are going to see the stock price falling back down towards 100. Therefore saying, every time I buy a stock, it pulls back on me. That's why you have to pay attention to the bid-ask spread. So what's the ideal bid-ask spread? Kind of depends on what kind of company you're looking at, what the stock price is. So if we look at something like JP Morgan, $243 a share, I think it's okay to have a bid-ask spread of 10 cents, right? But if we're trading something that's maybe $10 a share, $30 a share, what have you, you need to have 1 or 2 cents. A 1 or 2 cent difference. Why? Because that means there's consensus between the buyers and the sellers. That's what needs to happen. Now, when do you see big spreads out there? When do you see big spreads? Usually in the morning, or if there's big news. In the morning, the market opens up, and everybody's overnight trades start settling, and everybody's excited that it's 9:30 and they can trade again. They haven't been able to get their fix since 4 p.m. the next day. They discovered companies that they can go buy. They saw that NVIDIA reported earnings last night. They're going to go buy it. They're going to go sell it, what have you. Stocks are just going to be flying all over the place. The bid-ask spread is going to be wild. It's going to be going everywhere. That's when you really see it. Or there's news that comes out during the day, and all of a sudden a company said X and Y happened, and you start getting movement of the stock price all over. You get crazy numbers of buyers, crazy number of sellers. That's where you're going to see them. I typically like to wait until about 10 after 10 o'clock in the morning. That's kind of when everything calms down. You see those bid-ask spreads kind of settle down. Let's go to something. So let's go to a couple of stocks I know that reported yesterday. Let's go look at NVIDIA. See, the bid-ask spread is 4 cents. Perfectly fine for that price of a stock. PDD, 7 cents. Perfectly fine. Snow, There you go. So here's snow. $168, I'm just going to call it $168.50, $168.90. You can see that the spread always changes. So this, when I opened it, it was about 28 cents. There, it's 23 cents, 26 cents. That's too big. There's a lot of manipulation going on here. They reported earnings last night. Now look at this. If we just come over here, I'm going to show you on the swing trading chart how much volume came into this. So if we look at the average volume, guys. Average volume over the last, let's just draw it. Look at this. Not a lot of volume. Hit average. Not a lot of volume. Not a lot of volume. Average, average, average. All of a sudden today, boom. It is 10:46 in the morning. So the market has been open for an hour and about 17 minutes. And we have a ridiculous amount of volume compared to average. You probably have 3 times average volume within an hour and 15 minutes, call it. That's where you're going to get manipulations. Now we're at 44 cents, 39 cents. You do not want to play with something like this. This is exactly my point when it comes to bid-ask. You need to pay attention to the bid-ask spread and make sure that the consensus between the buyer and the seller are about the same so you don't get screwed, or just use a limit order and roll with it that way. Okay, now that we have the bid-ask spread figured out, let's go to some patterns. Patterns are everything when it comes to trading. If you can identify patterns, you will be a very, very good trader. I'll show you an example of a pattern that I identified in a trade that I'm in, not really following my rules, but it was based off of pattern recognition. And how are you going to learn these patterns? Repetition. You have to go through thousands and thousands of charts to be able to see these things just like that. All right, so if we go to Papa John's right now, I know that there's a Head & Shoulders because it was on a live stream this morning. Somebody asked about it. So Papa John's. So this is the pizza company. A Head & Shoulders pattern. What exactly is a Head & Shoulders pattern? Well, a Head & Shoulders pattern is exactly what it sounds like. Here's your head, and I'll show you how it forms. Here's your shoulder, and here's your other shoulder. And then what happens after a Head & Shoulders pattern? Typically, you get a big fall in stock price. And you can kind of see, here's your body. That would be your body. Here's your legs if you want to draw them in. But you can see the head and the shoulder. So how do we get that? Well, here's what happens. Your stock price kind of runs up, and it stops a little bit, and then it goes again, and it makes a big run. Then what happens after that run? It pulls back down, and it tries to creep back up again, and then it just completely falls and completely fails. And you can see here, here's your shoulder, here's your head. So how are you going to identify Head & Shoulders patterns? Well, it's pretty easy. You just need to zoom out on charts and just start looking. So let's go back and just start looking at some Head & Shoulders patterns. And some of you may be saying, well, it's easy to see when you're playing Monday morning quarterback, but that is true. But you need to be able to see that before you can see it developing in real time. There have been so many different live streams that we've been on. Actually, I get people in the community now that just say, Mo, is a Head & Shoulders pattern developing on this? Because what we'll see is something like this. Let me see if I can kind of black out this side of the chart. They'll see, let's get rid of all that. They will really see that happening. So they'll see that we had a run up and a little pullback there, and that's going to be a W formation. It comes up here, it starts to pull back, and then you start to get this little rebound. And you can say, hey, is there a Head & Shoulders pattern happening? 100% there's a Head & Shoulders pattern happening. You can see it happening. Then you just wait for the subsequent days. You can eventually go short on it. And what will happen? Clear that out. Boom. That's what happens with it. You can see these things developing. It's really not that hard. It's just going to take repetition. So I would encourage you to, again, download however, maybe 50 to 100 stocks. I download the entire S&P 500, and I just go through and just keep looking for Head & Shoulders patterns. Looking for Head & Shoulders patterns is going to be such an important thing and pivotal thing. It happens so often on charts. Head & Shoulders pattern, look what happens. Boom, falls down. Head & Shoulders pattern, ran up, fell down. Here's another Head & Shoulders pattern right here, fell down. Here's another Head & Shoulders pattern right here, fell down. You can see that it happens on a consistent basis. You need to be able to identify them. They're very easy to see after you look at them over and over and over again. And that's everything that it comes to with trading. You need to look at everything over and over again. Now, something else that you can see is that you're going to need to be able to identify is the ugly face pattern. Ugly face patterns to me are a lot more common, but they do basically the same thing as the Head & Shoulders pattern. it just, this one you can see happening in real time even more. So if we just look at this, we can say, all right, stock price is running up. It hits a peak. It falls back down. You can definitely see this happening in real time. It makes a little trough right there, and it runs up again, and it hits that same peak that it did over here on the left side, hits it over here, and then what happens? Boom. Same fall that happens with the head and shoulders pattern. Now, why do we call it an ugly face pattern? Because here's your eye, and here's your ugly face, and what happens? Boom. You can see these everywhere. You can see these everywhere, and you can see them developing everywhere. And here's how you can see them developing everywhere. Pretty easy. So if we just kind of get rid of all that, like that, you can see, actually, let's get rid of that too. You can see that it's going to develop. So we know that if we get candles that go like this, 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 and stop right there, and the next day they go like this, and this, and this, we know that it happened. We know that the ugly face happened, and that it developed, and we're going to probably get a fall down to here. That's exactly what we got. It's beauty for swing trading. And then you can go, okay, where was the last resistance point? Well, the last resistance point was right here. So I know that it's going to fall to this level, then it's probably going to go up from there. And when it goes up from there, what's it going to do? Well, I already know that my left eye is over here. So now I'm going to look and say, I hope it stops, makes a right eye, and then falls back down again. That's how you can see these patterns. That's how you get that's how you're on the cutting edge of saying, okay, I know when to exit, I know when to enter, because it's giving me the exact points if it happens. Now, if this continues to go up here, let's say it goes like this, well, then the ugly face didn't happen. But 9 times out of 10, if the volume is not there, you are going to have an ugly face pattern, and it's going to fall right down on you, just like it does the majority of the time. All right, now that we have those two major patterns, those are the most common patterns that you are going to see. So you need to be able to master the ugly face pattern and the head and shoulders pattern. Now the trap door, I'm going to go to EA Sports here. This is a good example. It's not a great example, but it's a good example of the trap door. I'm just going to really zoom in here. The trap door has to do with the stochastic. And you know what? I can almost draw this one. So when you start having a trend that is going like this and it's starting to move down, right? And we want to have red on top of yellow. And you can see here that we have the yellow line, and it's kind of like wiggling, and it's going back and forth, and it's not really there yet. It's kind of like this, and we need to make sure, let me redraw this. We need to make sure, I'm just going to make it clean lines. We need to make sure that the red line is below the yellow line. You're often going to see this in the middle of the sweet spot. So sometimes we're going to have in the middle of the sweet spot, let's pull one up here. We are going to have right around here. I can actually just take a black marker and show this to you. So if we go and we do something like this, let's do that. So this is a perfect example of a trap door. Now what does that mean? Well, remember, when we're going long, we want to have red going on top of yellow, right? We want to have red going on top of yellow. But in many cases, it's not going to close. So the trap door means that the yellow line is on top of the red line, and it's getting so close. It's getting so close to converging, but it's not quite there yet. So we need to make sure that we get that red line to cross over the yellow line. Why? Because sometimes that red line is not going to cross over the yellow line. And I'll show you an example of what happens here. Sometimes it's going to look like this. It's going to look like it's about to cross, but what's actually going to happen? The red line is going to just go like that. And then the yellow line is going to continue like that. And you're going to continue your march down. That's the danger of the trapdoor. This is especially important when you're on the long-term chart. So always make sure that your red line is on top of your yellow line when you're going long on a stock, and your red line is below when you're going short on a stock. You need to make sure that you do not go in when that trapdoor is open, because the trend will not change many times, and it'll just continue in the direction that you're going, or that the stock is going, against the direction that you intend to go. Now that we have a couple of patterns down, let's talk about some candlestick patterns that we can see. And one of them is called a tweezer pattern. And you notice that one of the themes that we're looking for often is things that have a change in direction, right? We're always looking for a change in direction to get a advantage of saying, when is this thing going to go the opposite direction, and can I get into it early enough? So let's just go to, let's go to Apple. Let's see if we can find any tweezer patterns on Apple. And let me show you what a tweezer pattern is before we do anything. So a tweezer is really exactly what it sounds like. You have a candle, and the next day you kind of have the same candle, and you have long wicks on both. So these two wicks right here, these are your tweezers. So let's go to Tesla here. Tesla, and I found a little tweezer pattern here. So you have these two right here. You notice, let's zoom in a little bit more. Let's zoom in and you can see that they kind of have the same size body on them, and they have almost the same set of tweezers on them, or wicks. And what happens? Boom, change in direction. As I said, guys, these are going to be rare, but when you can identify one, it's going to help you immensely. So this is not something that you're going to look for on a day-to-day basis because you're often not going to see it. But in times of volatility, you're going to be one of the first people to pick it up, and you can ask anybody in the community that has been around or has been trading for quite some time. They understand the power of tweezer patterns. They don't happen often, but when they happen, it gives you an absolutely large advantage over the rest of the people out there. And another little trick that I can show you guys, it's called sharp arrows. This is something that you're not going to hear anybody talk about, but it's almost like you are going to find a stock price that flies up on you, and I'm going to draw on here. I'm going to use blue. A stock price that flies up on you. Oh, I guess I'm going to use yellow. I'm going to use blue. It's stock price that's going to fly up on you and come right back down. You can see this arrow was rather sharp. So it didn't have something like this. It didn't have this big rounded top where it took a lot of time to come back down. No, it was an aggressive move to the top and a move back down to the bottom. When you see a stock that runs up like this and has a big pullback the next day, you know that more often than not, this thing is going to just consolidate sideways before dropping at some point again. Just know that don't go long on this thing. Why? Because it's probably going to run into that same resistance point, or the peak, the top of the arrow that it developed in the first place. You can see here, kind of going consolidating, jump up, big jump down, and now you're just back into the same old consolidation channel, not going long until probably, 10, 15 days later, where you can probably break out above this level. But you just know that the top of the sharp arrow is going to be a very, very strong resistance point for the coming days, maybe the coming weeks. But that's another little tidbit that I've noticed over time, not some fast-stead rule that everybody uses. You're probably not going to hear anybody else talk about sharp arrows. You're probably not going to hear anybody else talk about tweezer patterns. But those are two things that I've noticed in my experience that over time can definitely help you out in the long run. All right, now let's go to one of my favorite patterns to identify, and that is the 50% rule. So I have two examples, CCL and Boeing. These are the epitome of 50% rules. What exactly are they? And actually, you know what's funny about what's going on with CCL right now? It's actually developing again, the 50% rule, and it's about to execute. So let's pull up a yellow marker here. Let's go back here, and I'll explain the lines I'm drawing in a second. There's your high. Here's your low. I'm going to draw it with two lines to make it more straight. And then I'm going to go right in the middle, and I'm going to draw another line. Now, oh, that was a terrible line. One second. Let me go here and draw a line. There we go. Okay. So what are these lines? Well, you have your high, which is above. This is your last high, your 52-week high, your all-time high, what have you. But this before the big fall happened. Now, when it falls, you're going to kind of draw your base. Where did it fall to? You can see that even if let me draw it in pink. I'll go here and here, and then 50%. You can see that even back in 2020, I had a 50% rule that was happening. I'm going to explain to you how I made a ton of money on this. So now let me take out my blue marker. What happens? A stock price falls greatly. Big drop. This thing fell from $50 down to $8. And then what happened? Well, all of these people that lost so much money so fast, they're saying, if I can just get half my money back, I will be happy. I don't care about getting all of it back. It's a hard thing to do to go from $8 back to $50. But if I can just get half of it back, I'll be happy. So the price moves up and it gets about halfway. And then what happens? Everybody takes all of their profits here and it falls right back down. And the people that didn't get out here, who thought it was going to go all the way back, they say, okay, next time if I could just get out half my money out, I'll just be happy. So it comes down here, it tries, it goes up here again, all in here, it stays up here. And everybody's like, okay, great, it's going to keep going, it's going to keep going, and then boom, it falls back again. And same thing. People didn't sell here, people didn't sell here. They're saying, all right, forget it. It's been months, it's been a year, it's been 2 years. If I could just get all my money back, and then boom, it happens again. Now, what is that? All of this right here, all of this above, this is all called overhang. It's just negative pressure pushing down on the stock. And it is incredibly difficult to break out of. This was 2020. This was COVID. We are now at the end of 2024. 4 years. 4 years. This has not broken above this 50% rule level. Can it break above a little bit? Yes, but if the volume is not there, what's going to happen? I've told you many times in this video, it's going to fall all the way back down. And you can see now, the 50% rule on this is about $28 if I'm just going to use whole numbers. I think it's like $27.63 or something. Somebody asked me on the live stream today, what should I do with CCL? It's a $25.50. I said, ride it to about $27.63 and make sure you exit because it ain't going to break through this yellow line, this 50% rule line. That's the beauty of the 50% rule. Now, how did I use this? Well, I didn't own CCL pre-COVID, but I bought it back here. I think I paid around $8 for it. And it went up here and I was going to hold it long term. And it went up here and I didn't sell it. And the next time when it got up in here, you notice here, there's a peak here, and a peak here. And it failed this one. It fell back down. It hit this peak, fell back down. And this peak, I remember I was hiking one day. I was like in the woods. And it hit about $32 a share or $30 a share. I don't really remember the number. And I said, you know what? The hell with this. I'm going to get rid of it. And I ended up selling it because it was a 50% rule. It looked pretty good. Here's where I was like, I could have made a couple more dollars, but it hasn't touched that level since 2021. That was April of 21. Why did I sell it there? I sold it there purely based on the 50% rule. This was an investment for me, but I used my charts to help me supplement my investing. And I said, there is no way it's getting through this level. It's just, there's too much bad news going on for the company. There's not enough volume for it. I sold it and it worked out. It hasn't touched 30, 32, whatever the number was in 3 years. So that's 50% rule. Let's give you another example. Boeing. Another company, same situation. Here's pre-COVID. Here's your high. Here's your low. Let's draw that high. And the middle ground is about $230 a share. Now, I didn't own it back here. I bought it down here. I bought it $100 on the nose. When it got to about $200, I think I sold it right. I think I did it twice, actually. I sold it here, and then I sold it again here. Why? 50% rule. It was the same thing, the overhang. Now, again, can it creep through? Yeah, it can creep through, but it's most often going to fail. Creep through, fail. Crept through just in 2024, the beginning of this year, completely failed. It's all the way back down to the bottom, basically. So let's say that you go long in this at $143. Make sure you're selling around $230, $240, whatever that number is. That's the power of the 50% rule. I absolutely love the 50% rule. It is the most helpful pattern, and it is so obvious to see. Anybody can see it, and you know exactly where your exit price is going to be. Now, let's say that you have a stock that is, getting close to, I'm going to go here. I'm going to go to my lists that I like during the show. I'm going to pull up Jets. Jets is an ETF of all the major airlines. So you have Southwest Airlines in here. You have United Airlines. You have Delta Airlines. You have American Airlines. All of them are put into this one cookie jar, and they roll. And I love Jets because Jets is I don't have to trade individual airlines. I can trade all of them at one time. So if I'm looking at Jets, actually, what am I noticing about Jets here? Funny enough, here's your high. Here's your low. Let's see if we can find that 50%. So it's going to come back down here to about $21. This is kind of your mid-level right here. Now, watch this. This thing is not ready to short. Let's think about some rules right now. So, are we in the sweet spot here? No, we're not. So we're not going to go short on it. But eventually I want to go short on it, and I want to be one of the first people to go short on it when the trend gets into the sweet spot with red and yellow. But it's not quite there. I know it's going to happen, but it's not quite there. It'll probably happen somewhere around here, and I don't want to miss it. So what am I going to do? I'm going to throw what I call a tracker share. So I have a list here this is just my list for stocks that are close to being traded. So I have Zim, Moderna, Target, etc. And sometimes this can be a lot. This is 10 stocks right here, 10, 11 stocks. If you come to my other watch list, you can see Look how many stocks I have on here. This is a lot to pay attention to. So if I just go to if I buy or short one share, I'm going to see Jets in my brokerage account every single day. It's easy for me to miss it over here. It's hard for me to miss it if I have a monetary commitment to it. So for $24, I'm going to go short on Jets. Best case scenario, I catch it early right here. I come through the sweet spot. Everything works out. Worst case scenario, it goes against me. I lose a couple dollars. So I actually put in a tracker share here at about $20 a share, $21 a share. So right now I'm down about $3 a share. But what's the beauty of it? When this thing turns down, it's going to. I'm going to be so early catching this right when it moves into the sweet spot because I have a tracker share on it. I see it in my brokerage account every day. Now, I only put tracker shares on things that are exciting to me in the moment and a reasonable price. If this was $240 a share, $4,000, I'm not going to go and do it. And don't have 20 tracker shares. This is for one or two positions that you're like, yes, I am going to grab this when it's going to come down. I am going to go long on this when it's time to go up. I want to catch it early. That's what you use tracker shares for. I have utilized tracker shares my entire career. My all 21, 22 years, whatever it's been at this point. The entire time I have utilized tracker shares, and they have never failed me. I encourage you to use them, but only don't go out there and have $1,000 in tracker shares on 15 different companies. No. Have one or two companies that you have $20 to $50 tracker share on and you're paying attention to it. If you have something that is like Tesla, for example, $342, I'm not going to go tie up $342. I'm just going to move this to the top of my list when the time comes, just pay attention to it every day and make a conscious effort to pay attention to it. But for something like Jets, no, I'm going to put a tracker share on this and pay attention to it. And when this drops into the sweet spot, I'm going to be the first one to attack it. Now, how can tracker shares be utilized? Well, a great way of using them is on what I call power stocks and dog stocks, more importantly, dog stocks for this conversation. So what's a dog stock? Well, a dog is a company that has moved through the sweet spot down, and it gets to the bottom, and what does it do? It just goes sideways. Just goes sideways, just goes sideways, just goes sideways. It's basically SOL. That's really what it comes down to. And as something goes sideways on the bottom, what happens to the stock price? The stock price goes down, down, down. So on something like Moderna, we know that maybe Moderna is not the best example of we know that it's going to go back up. Let's say this was a Google, because guys, this happens to companies like Google. Trust me. Let's say that Google's on here on the bottom. I know that at some point Google's going to come back up here and it's going to move into the sweet spot and it's going to go for a nice run. I don't know when that's going to happen, but eventually it's going to happen. So with a dog that's just rolling on the bottom, nobody's paying attention to it. They're saying this company sucks. It doesn't work anymore. Maybe I go throw a tracker share on it. Maybe I take $36 and throw a tracker share on it. Absolute worst case scenario, because remember, I'm going long here. Worst case scenario, Moderna goes out of business. It's never traded again. I lose $36.76. Is it the end of the world? No. The upside for me was that this happened, moved into the sweet spot, things were really good, and I caught a giant run up, and I've caught many giant runs up. You just need to know, if I would actually encourage you, have a dog stock watch list. Take some dogs, throw them on there, and make sure that you follow them, and eventually you're going to see this thing is going to start to creep. So in summary of this one, a dog stock is a stock that gets to the bottom of the stochastic. You can see how low it is. 1.29, and it just goes sideways for a very long time. And as that happens, the stock price goes down. Tons of negativity on the stock. Pay attention to those, because eventually they're going to turn up. Nobody's going to be paying attention to them. All of a sudden, red and yellow are going to move into the sweet spot. You're going to find it. Other people are going to start seeing the prices moving up. They're going to jump into it, and it's going to go on a nice run. It's happened many times to me. Now, conversely to that is a power stock. Power stocks in today's market are incredibly rare. I only know of one, so I'm going to pull it up as an example. It is Walmart. A power stock is a stock that is making a new 52-week high and over all four major moving averages. So the stock price is above the 25, it's above the 50, it's above the 100, it's above the 200, and it's making new 52-week highs. And what happens? Well, look at this, guys. This is what you're going to see. You're going to see Walmart that came through the sweet spot nicely. Look, came through the sweet spot in the beginning of the year, and then it just started going sideways on the top. And it just kept going sideways on the top. And as you go sideways on the top, what happens? Just like dog stocks, when you go sideways on the bottom, the stock price continues down. When you go sideways on top, what happens? The stock price just continues to go up and up and up. And there was no reason to exit this thing. I'm going to show you, I'm going to loop something else in here. You see how we were on top and we started moving down like this? We were on top, started moving down like this. There was no reason to exit this. There was no reason to exit this. Why? Because we didn't drop below 80%. You're not exiting a long position unless you drop below 80%. That is going back to the trend is your friend. If the trend is your friend, if you follow the trend, you're going to do well. If you don't follow the trend, you're not going to do well. You need to be able to stick with this and say, okay, I got a little bit of a pullback here. It's really not that big of a deal. The trend is telling me to stay in it. And look, what if you exited in here? You would have missed this entire run. If you would have exited here at $67, you wouldn't be at $86 making new highs right now and in the power stock. So come through the sweet spot, go sideways, making new 52-week highs. Overall, 4 major moving averages, that's a power stock. You don't see many power stocks out there these days. I know of one. It's Walmart. Doesn't mean that there aren't others out there, but in really, really good times when there's not a lot of uncertainty, you're going to see a lot of power stocks. Those are great stocks to capitalize on. So this chart actually leads me into something I really want to focus on now. It's snapbacks. So what exactly are snapbacks? Well, snapbacks are when, and I'm going to use Walmart again, like I just said, we move through the sweet spot, we go sideways. This is a snapback. A snapback is when the stock price pulls back on you. It doesn't mean exit. Just, this is where traders lose. They think that price action determines what they should do with a stock. They think that because the stock price has gone from $50 to $75 and now it's back to $65 or $70 that they should exit. No, don't look at the percentage of gain and loss. Pay attention to the trend. If you pay attention to the trend, you are going to do very well in the end. Just like I said, guys, if you would have exited this thing at $71.50, or if you would have exited, you wouldn't have known to exit there. If you would have exited at $67, this is where you probably would have exited, somewhere in here, $67.50, $68. You would have missed this entire run to the top, right? And the most important thing about that, and the reason that you should have never missed this run to the top, is you never drop below 80%. If you drop below 80%, then you can exit. If your trend doesn't change on you, even if you're coming through the sweet spot here, look at this. Here's another example. Let's say you entered somewhere in here and you ran up and all of a sudden, look, this pulled back. You got a pullback right in there. Should you have exited? No, the trend was perfectly fine. It was perfectly on your side. You cannot exit stocks based on price action moving. You have to exit stocks based on when the trend is telling you to exit. If you follow that rule and you don't exit on snapbacks or you don't get freaked out by snapbacks, you are going to do very well. I think I'm going to give you another example here. It was either AMD or Micron. It goes back to 2021, so I got to find it, or 2022. Yes, perfect. So I'm going to go long term. This is a trade that I made back in 2022, or 2021. I don't really remember. It doesn't really matter. The point is, you had, I think we entered in here. I think my entry point was right in here. Came all the way down, and then I got this big snapback here. So I basically entered here, gave back almost all of my gains, and then what happened? The snapback, this was just a snapback channel. It came all the way down here. So I would have given, if I exited or got worried or didn't trust my trend, look, the trend never popped above 32%. It stayed below it, so I stayed in it. If I would have exited here and said, oh man, I just had a great trade. I went from about $120 to about $80 a share, and then it came all the way back to $115. If I would have exited there, I would have been really mad if I didn't get it all the way down here to $70, right? It's because I trusted the trend and stayed in this that it worked out for me. Let's look at another one. I think Micron. No, it was Zim. Zim was another one. Same time frame. Let's see here. I know I did a trade on Zim. I'm just trying to remember. Yep, it was right in here. It was these two big days that happened. You had these big 2 days, entered there, moved it down. You got this big snapback. And then I would have missed all of this run down. That would have been a travesty had I missed something by thinking that, oh man, this little snapback was going to throw me out of the game. That would have been really, really silly. You have to trust the trend. You have to trust the trend. If you trust the trend and you don't worry about snapbacks, you are going to do very, very well in this. So that leads us to, when do we exit? Well, we kind of already went over it. Let's just go back to Walmart because I'm going to show you an exit in real time. The exit point is pretty easy. And this goes for the swing trading chart. This goes for the weekly chart. It's the same thing because the trends are the same. When I get my red line here moving on down, drops below 80% with red, yellow is going to follow it, of course. It's going to kind of look like that. That's when you exit. You exit when red drops below 80%. Or if you're short on something, you exit when red pops above 20%. Very simple. That's it. If you want to take some profits, you can take some. So let's go to something like Moderna, mRNA. And this is a company that I actually just took profits on this morning. And we're going to draw in some resistance points. We're going to get a little bit advanced here, but I want to show you where you can take profits. Well, first of all, what does taking profits mean? What's the difference between exiting and taking profits? So exiting means you're exiting the position. Exit equals a 100% removal from the position, right? Taking profits. I'm going to write TP. This means you're taking your profits off the table. So if you invest $1,000 into a company, right? And let's say that you go long, it goes up 10%, you're happy, and now you're running into a point of resistance, right? Well, you're going to take some profits off the table. Let's take off 10%. So if you're at $1,100 a share now, you're up 10%. That's $1,100. You're going to remove $100 off the table, and you're just going to go back to your basis. So now you're playing with profits. That's how I look at it, as for taking profits. Now, I'm looking at Moderna, zooming out. Look, you had a consolidation channel here back in 2020, and you're kind of stuck at that same level. This green dotted line is exactly that level. So this morning I took profits. Why? Because I was running into this level. I'm not exiting because I do think there's more room to run. If we go like this, you can see here's the top of the consolidation channel. Here's the bottom. I think I can get to the bottom of the consolidation channel. It's about $31. But I already have profits in my pocket. Now I'm just playing with house money. So if it moves down any further, sure, I'm gonna make money on the way down. I can always add more money in, but I'm still gonna make money, but I have a little bit of a security blanket in there. So that's the difference between taking profits and exiting a position, and that's kind of how you can go about using exit strategies. Also, if you're running into moving averages, take some profits. If you're running into strong levels of resistance, if you were in Moderna and you were coming up, and let's say that your stock price was running into this yellow line, take some profits. Don't exit, just take some profits. Keep following the trend. If the trend doesn't tell you to exit the position, you don't exit the position. Just take some profits. Now, this is a very, very important point here. And you see all these E's on the bottom of the screen, right? E. What the hell does that mean? Well, it means earnings. What is earnings? Earnings happen quarterly, 4 times a year for every company that's out there. And they basically report what happened during the quarter, what happened during the fiscal quarter. They'll say, we reported earnings per share of X. We reported revenue of X. This is how many sales we had. This is how much profit we had. This is how many, if they're a subscription-based business, this is how many subscriptions we had. This is how many subscriptions we lost. If they're a pharmaceutical company, this is where our drugs are in certain phases, et cetera, what our sales were on certain drugs. And the market typically reacts irrationally to them. So look at this. I'm actually going to take you to, let's take you to Zim. Zim's a great example today. So yesterday and today. So Zim yesterday reported earnings. So they always give an estimate. Estimate is what Wall Street expects to happen. They expected earnings per share of $6.95. They came out and reported $9.34. For those of you that don't know, that is an absolute crush. Okay? They were estimated to do $2.39 billion in revenue for the quarter, and they reported $2.77 billion for the quarter. Again, absolute crush. Well, look what it did. Look what happened to the stock price yesterday. It jumped up here. We opened the day right here at $29.61. Crept up a little bit. That's why you have that wick, and then it pulled all the way back down. So yesterday, all they did is they were up 0.86%. And intraday, they were up about 10%. And today, now that people have digested the news, down 13.44% as of right now, 13.5%. Earnings are a total crapshoot. What do I mean by that? It doesn't matter what the company reports. It can go wild. Let's just go and look at some Meta earnings. Meta went wild there for a while. Look at this one, guys. Meta reported here. Earnings estimate from Wall Street, $4.32. They reported $4.71. Sounds pretty good to me. 36.15 billion was expected, 36.45 billion. So they had a beat on the top and the bottom line. And what happened to the stock price? The stock price fell about 11%. Total crapshoot. And then look what happened after that. It just went back up. Here, let's see what happened here. Beat on top and bottom line, big jump up, 20%. It doesn't matter what the company reports. It matters how Wall Street digests it. So what do I recommend for that? Well, if I'm in a stock, I'll go back to Zim, for example, because I am currently in Zim. But this so they reported earnings in the morning on the 20th of November. You can see in morning here before the market opens. So I was out in the evening of the day before. I was out in the evening of Tuesday. And I let this happen. And then this morning, I entered back in. What's the point? Do not be in a stock during earnings. Let me repeat that. Do not be in a stock during earnings. You're probably saying, what are you talking about? You need to exit your position or reduce down to a minimal amount of shares. So if you have 100 shares in something, reduce it down to 10, 5, 1. Do not be in that stock with your 100% position. You are going to get burned. I promise you. And the worst thing that can happen to you is you don't get burned and you think that you're not going to get burned the second time it comes around, third time comes around. You are 100% going to get burned. Do not trade earnings. Make sure you pay attention to when your earnings are. Exit your position, reduce your shares in your position, then re-enter after the earnings is over and things situate. Do not trade earnings, please, for the love of God. So now that we've covered really everything that comes to charts and patterns, we can get into shorting. Now, what exactly is shorting? You probably have heard people talk about shorting, and you may have the opinion that it's a very risky thing to do. Let me tell you something. If you go into shorting and say, I'm just going to short this company, yeah, it can be a very risky thing to do. The loss is 100% infinite. But if you go into shorting on a chart and have stops in place and understand where you need to exit, how you can make money on the way down, you are going to do very well. Think about it this way. Stocks go down a lot faster than they go up, right? I do not think that you can be a successful trader if you do not know how to short. That's my personal opinion. I think that you need to make money going in both directions. You may have heard me say in other videos or in the past, maybe in this video, I don't remember, I use 5 stocks. I like to trade 5 stocks. Now, you might look at that as 5 stocks. I look at it as 10 stocks because I can go, let's say that let's come over here and just see my screen just so I don't have to think about them. Zim, that's 2 stocks because I can go long and short on it. Moderna, that's 2 stocks, long and short. Target, Starbucks, Jets. Those 5 stocks right there, I can go long and short on. Therefore, I basically have 10 stocks. That's the way that I look at it. You need to be able to understand that shorting is nothing more than taking your computer and flipping it upside down. And I'm going to show that to you here. So what really is shorting? Well, in very, very layman's terms, you're betting against the stock price to go up. So if we look at this and we say, stock is at $10 a share, okay? And you buy 1 share and it goes to $11 a share. You're happy, you made $1 a share, right? Well, if you're shorting it, you're upset because you lost a dollar a share because you're betting against the company. On the contrary, let's say it goes to $9 a share and you were long. Well, you lost $1 a share, but if you're shorting, you made $1 a share because you're going against the company. You're betting on the company to go down in price. That's what shorting is. So when we're looking at a short, we're basically saying, okay, if a long is our red line comes to the sweet spot and we wait for it to get over 80% and yellow follows and we wait to get over 80% and that's the goal, to come through the sweet spot and get over 80%, then what's shorting? Shorting is exactly the opposite. We're waiting for it to come back down and go below 20%. And we're waiting for the yellow line to be above and go below 20%. That's the difference in the trend. So to go long, this is what you're looking for, red over yellow going to the top. And to go short, you're looking at red over yellow to the bottom, going to the bottom side. Very, very simple. That's really the simplicity of trading. And I want you to take out all the noise of the pundits that you hear on TV, all the other people on YouTube that you say, oh, they don't know what they're talking about. Shorting is dangerous. No, shorting is not dangerous. Shorting is dangerous if you act like an idiot doing it. But if you don't act like an idiot, shorting is not dangerous. So let's look at some candles of what shorting looks like. So to me, Zim, let's actually draw what's going to happen with Zim, okay? Let's kind of ignore what's going on over here for the time being, and let's draw in what we think is going to happen. So we have a couple of days here. This was earnings. We had a big jump up. It's coming down now. So I'm looking and saying, all right, tomorrow. Let's say we close the day here. We go like this. We have a couple of days where it starts to come down. And then what's going to happen to the trend over those 4 days? Well, the trend is probably going to do this. Probably going to roll like this. And the yellow line is probably going to come up, and it's going to roll like that. And you notice, red under yellow. We're in the sweet spot, right? We're moving down. Now, what are we looking for? Boom, boom, this. All of a sudden, we get the rollover. Now, what are we looking for? We're looking for an engulfing candlestick. Just like we look for those engulfing candlesticks going up. When the trend is coming through the sweet spot going to the top, we're looking for the same thing. Remember I said at the beginning of the shorting piece, you flip the chart upside down, right? So now we look for an engulfing candlestick. Boom, there's your engulfment. That's your buy signal or your sell short signal. You're in the sweet spot, and now you are on your way down. You're probably going to get more and more things. Then you start looking for your resistance points or your support levels on the way down, just like you look for them on the way up, and you're going to be a happy camper. And exit the position, you just buy back your shares. That's how simple shorting is. You look for the same things. The resistance points are just reversed. The support levels are just reversed. The moving averages play the exact same role, but you're just coming down into them instead of going up into them. You still pay attention to the engulfing candlesticks. You still pay attention to selling volume versus buying volume. So if we come over here and we look at the volume, we're looking for selling volume instead of buying volume. The trend, just the opposite. Actually, look at this. I just noticed this. This is the swing trading chart. Look where we are. This is actually a perfect short today. If somebody was watching this today, which they're not because it's being pre-recorded, you could go ahead and short this thing. And you might say, well, you're on top of the 100-day or 25-day moving average. Yeah, but your volume is perfect. It's probably going to stay below it. Or you can wait until 3:55 in the afternoon to execute the trade just to make sure it stays there. But this is the perfect setup. Yellow, red under yellow, a lot of volume, engulfing candlestick. You can see how it's exactly the same as going long, but you're just going in the opposite direction. And it happens faster than going long because it's easier for a company to lose a bunch of money or the stock price to go down than it is to make money and the stock price to go up. Now that we've covered shorting, let's get into day trading. So if you remember, I talked about the trajectory of a trader. People come in right away and they are really excited and they want to get after it. And day trading is a very, very fast-paced method of trading, and it's very, very lucrative. The caveat can be that you can get burned out by it, but you could also not get burned out. I did it for 2 or 3 years consecutively every single day. I know people that do this as a career. They've been doing this for 20 plus years. The whole thing, and you notice there, 20 plus years. How do you do that? Well, you figure it out. You figure out how to do something that is not emotionally draining. I have a friend right now. He day trades every single day. He hasn't missed a single day in the year 2024, and he absolutely loves it, and he's doing a fantastic job. If you can figure out a way to handle your emotions and not have extreme highs and extreme lows, plus you have the time to sit on your computer all day, every day, or 4 days a week, or whatever your schedule you choose, then day trading can be for you. But let's walk through it and see exactly what it is. So going back to the very beginning of the video, I explained what day trading is. The most important part about this, you are in and out of a stock in the same day. So come over here to the screen and check this out. I'm just going to look at, this is Friday right here. You notice I have this blue shading kind of in this area. Then it's like this reddish orange shading. So the blue shading is your post-market trading. And you can see here, this is post-market. So this is basically from 4 p.m. to, I don't know what time it goes to. And then the morning comes around, maybe 6 a.m., 4 a.m., whatever it is, all the way through the 9:30 time slot. And then the black area is your intraday trading between 9:30 and 4 p.m. Eastern time, of course. So what we're looking for is trading in these time frames. You want to be trading between 9:30 and 4 p.m. I do not recommend trading post-market, pre-market, anything like that. Why? Well, again, it goes back to volume. You're not going to have the volume activity there that is needed to drive the stock where you need to go. So even when you're out there trading currencies or Bitcoin or commodities, I still recommend trading them when you are during the normal market hours. Do they trade 24/7, 365? Yes, they do. The problem becomes, is the volume going to be there? Sometimes the volume could be there. Bitcoin has been going crazy lately. I am sure that there are many times in the middle of the night or after hours, what have you, that Bitcoin is going wild. If you're sitting on your computer and you see a big run up in volume, go for it. By all means, go for it. But as a general rule, try to trade during normal market hours. It's going to help you. Now, let's go over, we set up the chart already. I showed you guys how to do that, but let's go over a couple of things. So these candles here, each one of these candles, as a reminder, is a 15-minute candle. So this is 15 minutes, this is 15 minutes, this is 15 minutes, opposed to the other charts, the daily and the weekly, that are daily candles. So if we look at this long candle right here with this long wick on it, 9:30 a.m., 9:45 a.m., 10 a.m., 10:15 a.m. You can actually see it's 10:16:02 on my screen right now. This candle right here, this just formed. So if we were, during this video, if you were watching my screen, very possible that you saw this thing just form out of nowhere. That's going to a new 15-minute time frame. Then you come down here, you look at the volume, we make sure that the volume is there, and then we look at our stochastic on the bottom or our trend line. Now, let's go over one more thing before we get into showing you a trade. This is no man's land. No man's land. You don't want to be down here trading in no man's land. You want to be above 80% or below 20%. Remember that. It's very important to remember where the sweet spots are when it comes to day trading. Now, what do we look for our entry points? Well, guys, it's the same thing. Everything comes back to volume, buy signals, engulfing candlesticks, etc. So if we're looking here at JP Morgan, I'm just going to go back several days and I'm going to kind of cherry pick a good example of a trade. And I'm going to go long on a trade because it's going to be easier for me to show you, especially if you're new, a long-term trade than a short trade. So you're also noticing I'm going back. It's hard for me to find something here with JP Morgan. That leads me to believe that JP Morgan maybe isn't a great stock to day trade. This is a good way for you to go and find stocks. Just pick a stock, pick maybe your favorite company, and just go and start moving around. Do I see a lot of consecutive days? Now here, this day, you can absolutely day trade it. But if I go and let's see, yeah, you can see right here, maybe, but I have to go to this day. No, nothing here. Notice how I don't get to trade JP Morgan on a consecutive basis. It's every once in a while I get to trade it. Probably not one of your best stocks for day trading. So let's look at this one. 9:30 in the morning opens up. Your stochastic opens above 80%. You have really nice volume coming into it. If you are an experienced person, you can start trading here at 9:30 in the morning. I tend to recommend that because of what we spoke about. You know how it goes, this goes back to bid and ask. You know how everything connects here. The bid-ask spread is going to be rather large. Now, that can be good for day trading because what do we like to see in day trading? Well, we like volatility. Volatility is something that we want to see on a day trading chart just because we can go in there and grab something and get out of it very quickly. Opposed to a swing trading or a long-term trading chart, we don't necessarily want to have something that is going to be volatile day to day, minute to minute. No, that's not what we want to find over there. But when it comes to a day trading chart, that's perfectly fine, or 15-minute chart, I should say. 9:30 in the morning, jumps up. I don't like it there for a new trader just because it could be a little bit more difficult. I would wait until later in the day, maybe 10 o'clock. 10 o'clock you can start trading. But even here, I'm not loving this trade as I'm starting to draw the example. So let's go to an NVIDIA. NVIDIA is probably going to be, and exactly, here we go. NVIDIA is perfect. This is, I don't know what day this is, but I'm just looking for patterns right now. What are we looking for? Good volume. You had that throughout the entire afternoon. Stochastic, over 80% engulfing candlestick. You get into it. Now what do? Well, now that you're in it, you just let it go up. You notice the stock price went up, it pulled back down, but what is your stochastic doing right here? Let me clear this out. What is your stochastic doing? Well, it's still charging forward. You're still getting good volume coming into it. You're in it. When do you make the change? When do you move out of a stock? Well, there's two ways that you can do this. This is the way that I prefer. I always keep this yellow line up here on a day trading chart. You don't necessarily need it, but when I see the red line turning down and kind of converging with the yellow, that's when I make my exit. And if the red line comes back up and starts going back to the positive, I just re-enter the position. But I like to have this yellow line there. It shows me the trajectory of the red line. And as it comes down and converges, boom, I'm out of it, move on. And in this instance, it was a good idea. Now, the second way you could do this, if you wanted to, be a little bit more systematic about it, you could enter when the red line drops below the 80% line. But I feel like I give away too many gains when that happens. I would rather exit up here when I see the trajectory start to change and take the risk of kind of missing it if it takes another leg up, or just re-enter it. It's very, very simple to just re-enter the position as well, rather than it dropping, getting to 80%, giving back a lot of the gains. That's my personal preference of how I like to do it. And guys, that's really it. That's what it is when it comes to trading on the 15-minute chart. The technicals of it are very easy. You have stochastic, you have your trend, you have your volume, you have your buy signal. Then you have your exit signal. Very, very easy. The hard part is when you see this. When you see the price go up like this and come back down and then start here and go down and then go up and go down. You have to be emotionally ready for that roller coaster. I don't care if you've paper traded for 3 months. When you put in real money, even if you put in $1, you're going to see this thing going up and down. You're going to be losing 5 cents, 10 cents, and it's a different feeling when it's real money. Trust me, even if it's just a nickel or a dime, I promise you. So you need to be able to become comfortable with this and understand that you need to trust your trend, trust your volume, trust the patterns that you practice. And the best way to do this is just go through and find different patterns. Find this pattern right here. Good move up. Good pattern right here. Good pattern right here. Good pattern right here. And then paper trade. Paper trading is going to help you get to the point of trading with real money. Okay, now let's get into swing trading. So when we think about the trajectory of a trader, we have the person that comes in and they want to get after it and they're day trading, but you're going to find that it can be emotionally taxing. So what are you going to do? Well, I'm probably going to go to swing trading. It's a little bit slower pace. So we talked about swing trading already. It's over here on the daily chart. And what's our difference going to be? Well, I'm just going to briefly explain this. The difference is there's detail on this chart. And it's going to go back to everything I just told you about when it comes to resistance points, support levels, the moving averages that you can use. The setup is the same. Actually, this is a terrible example. We're not going to use this one. We're going to let's just go back to JP Morgan. This is the type of stuff you see moving nicely through the sweet spot, nicely through the sweet spot. This is actually a little bit wonky moving through the sweet spot, but if we go back to that, I think it was deck. Guys, look at this. This is not what you want to see in the sweet. You don't want to see, when you have a daily chart, you want it to move nicely through the sweet spot, up and down and up and down. You don't want to have all of these reversals happening in the sweet spot. If you see something like this where you just consistently have these reversals happening in the middle of the sweet spot, move on. Go find another stock. This is not a good stock to trade. You're going to get abused in trading something like this. So let's see what NVIDIA, let's go back. I like JP Morgan. So let's look at JP Morgan. What do? It's very simple. Same thing as a long-term chart. When you're coming through the sweet spot, you cross 32% with red and yellow. You find your engulfing candlestick. Make sure the volume is there. Make sure you're not running into a moving average line, a large support level, what have you. You enter the stock. And when do you exit? Well, this one you exit when you drop below the 80% line. It's very, very simple. Now, the difference here is that you're going to have the opportunity to take profits. And we talked about profit taking already. So what would we do here? Let's look at this example right here. So let's look at this time frame. We come through the sweet spot here. We get this engulfing candlestick, and we start to move up. And this day right here, we run into the 25-day moving average. This, to me, is a time where you take profits. Remember what we said profit taking is. When you're running into a resistance point, when you're running into a support level if you're going down. So for me, I'm looking at this saying, well, I'm not exiting my position. I don't need to exit. The trend is perfectly with me. The volume is decent. It's consistent. but I'm going to be able to take some profits off the table. So maybe I bought in here at around, I don't know, let's just call it $205 a share. And this is about 207. So I'm going to take those $2 off the table, whatever that percentage gain is. And now I have a little bit of house money to play with. I'm not exiting, but let's see what happens on Monday. I'm just using days for example. Let's see what happens on Monday. Monday, you get an engulfing candlestick with good volume, breaking through the 25-day moving average. You close the day up here around the top of the candle, and you're on your merry way. And you just keep going. Now look, we're going sideways. What happens when you go sideways above 80%? The stock price goes up. Then you start to fall, then you start to fall. As soon as we drop below 80%, that's when you exit your position. That's when you exit your position. You'd already taken profits. That's where you exit. There's really no more support in here. You could have had a little bit of support here if we just draw these lines. See how we have that little ugly face pattern there? Ugly face there. And you have this big line that I drew. Can't get through that consolidation channel. Look at this candle right here. It hit that level and it fell back down. These are the things that you look for. Maybe you would have taken profits here, but this is going to come with experience. You're going to understand where you should take profits. Hell, it comes with being in the community and talking to me. I'll help you do that, and other people will help you do that. But that's the point. This is where you learn to take profits. Where are these different support levels? Why do I start taking money off the table? When do I start putting money back on the table? When do I exit a position? And this is really swing trading. Swing trading has a lot to do with support, resistance, taking profits, and those moving averages. All right, now we've gone over this. I've shown you, I've used JP Morgan in a couple examples. I've pulled up NVIDIA here. I pulled up that deck thing, which I would not trade. Now you might be asking, well, there's thousands and thousands, there's tens of thousands of stocks out there across the world. How do you choose a stock to trade? Well, I'm going to show you here. Now, there's a couple of ways that you can do this. This is my favorite way, and this is the way that I've been doing it for a very, very long time. So you come over here to Yahoo Finance, and you click on Markets, and you go to the most active. So when we're looking at most actives, what exactly does that mean? It means the stocks that have the most participation of volume. So if you look here, look at the volume list. NVIDIA. 93 million, basically 94 million shares traded today. Super Micro Compute, SMCI, it's moving like crazy. 72 million, Mara, and you can just see the list and you can see the volume dwindles as you go down. Write down these top 25 and say, okay, I'm going to write that down on Monday. Tuesday, I'm going to come and write down the same thing again. Wednesday, same thing again. And see which 5, 6, 7, 8, 9 stocks are in there every single day. I can promise you that just looking at this list, NVIDIA you're going to see in there every single day. Tesla you're going to see in there every single day. You're probably going to see Rivian or NEO in there every day. Pfizer maybe, Palantir probably, but these are the ones that you're going to see every single day. And why are we looking for that? Because it goes back to volume. We want stocks that have a lot of participation in them because participation means that there could be a higher level of consensus. Or if you're day trading, you have a lot of volatility. You could have a lot of volatility coming into it. So this is what I like to do. Come in here to Markets, click on Most Actives. Now, something else you could do. If you're a day trader, this is what you can come and do. Stock Gainers. Come over here to Gainers, and you notice Scholar Rock Holdings. It's up 32% today. Go and try to grab a percentage of it. Bridge Biopharma. I don't know what that is. Go try to grab a percentage of it. That's something that you can do. I personally like to go in and just say, you know what? I'm going to have my 5 stocks. I'm going to play with these 5 stocks every day. But if you're somebody that just wants action, you want a lot of action, go and play with these different areas. You can come over here to Biggest Losers. If you want to short, come over here and you can see Kingfisher down 14%. Zim down 6%. I'm trying to see other ones that I'm familiar with in here. Oh, NVIDIA down 3.5%. Try to go and grab a little bit of it. These are just different ways that you can go and pick stocks. Now, after you've picked the stocks, let's say you have your 5 stocks, right? Now it is, Mo, are there best times to trade in the market? And that answer is absolutely yes. There are best and worst times to trade in the market. So let's go back to the chart, and I'm going to go to the 15-minute chart, and we're just going to look here. The best time for me to trade in the market, and this kind of goes back to the bid and ask, 10:06 a.m. That's my favorite time to trade. And you say, that's a really random number. Why 10:06? Because all of the post-market, pre-market news has pretty much been washed out. Look at this. If we go back to, let's just go back to Yahoo Finance and click on this headline. Let's go and look here. Stocks jump after Trump picks Bessent for Treasury. MicroStrategy, huge deal going on there. Macy's reported. Get all that out of the way. Apple's Tim Cook, a CEO summit with Chinese on trade. If you think that these headline stories are not going to move markets for the first 30 minutes of the day, you're crazy. You're absolutely crazy. I'm looking for some other things here. Bath & Body Works stock jumps. Okay. China backs NVIDIA. You are going to have movement. And that movement is probably going to dwindle in the first 30 to 35 minutes of the day. That's why I choose 10:06. I just say, let 36 minutes go by. Let's just let all the crap get away. Let's all the overnight trades settle. Let's let all the options trades settle. Let's let everything calm down, and then we'll go and start trading. So 10:06 is the most calm time, and you're going to know this by looking at those bid-ask spreads. When you look at the bid-ask spreads and you see that they go from 20 cents to 1 cent, then you know everything is over. That's exactly the best time to trade, in my personal opinion. The next great time to trade is 1:30 in the afternoon. So if you're a multi-billionaire and you're on Wall Street and you are like a Bobby Axelrod or whatever, Bill Ackman, you're probably going to leave your office around, 11:30, and you're going to probably go have either important meetings or have a lunch or whatever from probably 11:30 to 1 o'clock, 1:30, somewhere in that time frame. And when you get back to your office, you're going to pick it back up. And I want you guys to pay attention to this. Look at this. If you just come over here to the 15-minute chart, look at this. This is the morning. This is 9:30. 9:45. This is 11 o'clock. This is the run-up. This is about 12 o'clock. And then look what happens to the volume. It dips. It dips down. And then look what happens here. A little spike happens right around 1 o'clock, right? You're going to see that a lot if we just start moving around. Let's look here again. You have your morning. You have your morning. You have your morning. It just dwindles. It dwindles. Here's 11:30, 12 o'clock. And here it just starts to pick back up around 1, pick back up around 1, pick back up around 2. You're going to see this consistently happen with stocks. This is NVIDIA, and you can see the lull that happens here in the afternoon. And then what happens around 1 o'clock, 2 o'clock, it picks back up. That's why 1:30 to me, 1:30, 2 o'clock is the best time to go, the second best time to me to go back in and trade. You need to trade when people are participating in the market. You are going to get absolutely killed if you go and try to trade between 11:30 and 1 o'clock. There's just nobody there. That's like trading post-market. It's just not going to go well for you. Now, another time that I like to trade, especially for day traders. Now, I shouldn't say that. Well, I should say that. Especially for day traders, but especially for those that want to enter a position. You'll often hear me say on live streams, I would wait until about 3:50 in the afternoon to make sure that this candle stays at the top of its price action during that day. Now look at this, 3:50, kind of right around. Actually, it's actually 3:30 to 3:50. Look at that pickup. Look at that pickup in volume right there. That's what you're going to see. Let's go over here again. Not a lot going on. Not a lot going on. Pickup in volume right at the end of the day. Not saying that it's going to be stellar every day, but look at this. Moving around. Big candle at the end of the day. That's today right now, so let's just keep going backwards. And you get the idea here. This is a crazy day, but big, huge candle at the end of the day, even relative to what kind of volume you were getting throughout the entire afternoon. Big candle at the end of the day. Big candle at the end of the day. 3:45 to... I like going in at 3:50. 3:45 to 4 o'clock is a huge time to execute day trades. And it's also a great time to understand, is my stock going to stay at the top of the candle at the end of the day or the bottom of the candle at the end of the day, depending on which direction I'm going in, long or short. That's when I like to go in, just to make sure that the volume is there and it's going to keep my entry point consistent with my belief of which direction that the stock is going to go. Now, another time that you can trade, and this goes back to the day trading section, is 9:30 in the morning. I personally do not recommend that anybody trades at 9:30 unless they are a very experienced trader. Back when I was day trading, there was a company out there, I think they went out of business. Yeah, they gone. So it was the ticker symbol was SUNE. It was not Sun Nation Energy at the time. I don't know what this is. SUNE, every single day. The second the market opened, actually it would do this. It would do this every single day at 9:30, and by 9:35 to 9:40, so within the same candle, it would pull all the way back down, if not lower than its entry point of the day. And I made a killing doing that over and over and over again. But that was an incredibly risky thing to do. Why? Because you knew that this thing was going to pull back really, really hard. It was just a matter of when. You had to follow the volume. You had to understand that this stock was going to do that every day. And if you were not fast enough or you could not get your shares filled, you were going to lose a lot of money. That to me is something that a very experienced trader needs to be able to execute on. If you're new, please do not trade at 9:30. Go and start trading at 10:06. You can maybe eventually graduate to 9:30, but 9:30 is a great time to trade volatility because, like I said, all the overnight stuff is settling, all the news is settling, which is great if you want volatility and you want to make a quick buck really, really quick. But it can also hurt you if you don't know what you're doing. And now the worst time to trade, 12 o'clock. 11:30, 12 o'clock, it's just not worth it. Why? I told you guys, the volume portion is not there. It's like trading after market. So if you really think about when the market's open, it's 9:30 to 4 p.m. To me, I look at it as saying, okay, it's open from 9:30 to 11:30, so there's that 2-hour window. And then it's open from, call it 2 to 4 p.m. So the real stock market, if you really want the real action of the market, it's really 4 hours a day. That's about it. That's all that you have. The other stuff is just noise. So make sure that you're trading during the real market hours when people are in the market trading and the big guys on Wall Street are sitting at their desks executing those trades. All right, now that we have the best times to trade, let's talk about the checklist. So you'll notice that many things I've said here have been make sure that you're not running into resistance, make sure that you have an engulfing candlestick, make sure the volume's there. Well, I have a real checklist that I actually go through each time, and I take this and I actually have it on my desk, sitting there, or on a computer, whatever it is, I have to go to this every single time just to make sure. Still to this day, I make sure that all of these things are checked off before doing something. So the first thing is the time frame. Let's make sure that it's after 10:06. I know that a lot of people get excited and they come in and they say they might see a big engulfing candlestick right off the bat, and it's 9:45 in the morning. There's a very good chance that by 10:06, that thing is going to pull all the way back down. So make sure that you are in the right time frame to be trading after 10:06. When it comes to long-term and swing trading, do not trade before 10:06 in the morning. There's no exception. Doesn't matter if you're experienced. That doesn't matter. That is going to save you a lot of headache in your trading career. The next one, make sure you're checking out this bid-ask spread. Even in the middle of the day, even at the end of the day, make sure you're checking out these bid-ask spreads. You want to make sure that when you buy it, the stock price doesn't pull it back down. I don't want to hear that comment from people. Just pay attention to the bid-ask spread and you are going to be okay. Now, red and yellow being in the sweet spot. Remember, we want to be entering down here. This is the swing trading chart. We want to be entering down here. We don't want to be entering up here on swing trades. We don't want to be entering here on swing trades. We want to be entering where we have a long runway. Think about when you're investing. If you're putting money into a stock for a very long time, what's the most ideal situation? You want the company to have a very long runway. Why? So you can pick up more speed to get in the air. Think about if you're going on a plane. If you want to be going as fast as you possibly can on the ground to get that good lift and go into the air and just be able to coast for quite some time. That's what starting back here is. You want to have that long runway. You don't want to be trying to take off on a short runway with not enough speed. It's just not going to work out well for you. Then you want to have the volume. You may want to make sure the volume is up here. There's many times where I see a great engulfing candlestick, clear of all moving averages, stochastic is doing its thing, it's coming here through the sweet spot, and volume is, let's say that there's an average of 10 million shares traded per day, and you have 800,000. That's not going to work. 800,000 out of 10 million is not going to sustain you. You want to see average volume of 30% by 10:30 a.m. So in the first hour of the market day, you want to see 30% of the average volume. So if the average volume is 10 million shares traded per day, you want to see 3 million shares traded in the first hour of the day. It's very important to see that. Or just at least be consistent with the previous week, previous 2 weeks, what have you. Then you're going to look for your buy signal. Our trend is good. Our volume is good. Now let's look for the buy signal. The buy signal is, of course, the engulfing candlestick. The engulfing candlestick. The engulfing candlestick. Make sure it's an engulfing candlestick. You don't want to buy something that had, like today, this candle on JP Morgan. This is not an engulfing candlestick. This is a candle with a wick all over it. This here, not an engulfing candlestick. Why? There's a long wick on the bottom. Hit this. Wicks on both sides. Long wick on the bottom. Doji. You need to have an engulfing candlestick. All right. Then, clear of resistance and support. So if we zoom a chart out, actually, let's go to the other chart. Let's get rid of the moving averages. I want to be able to draw in lines. Let's say that this is a perfect example. There's a peak here. There's a peak here. Okay, you're coming through the sweet spot here. Let's assume that the volume is good. It's over average, and you get an engulfing candlestick that runs right into this yellow line, this yellow horizontal line I drew. Well, great, but you're probably not going to push through that level unless you have multiple days in a row of great volume like the volume bar that I drew here. Why? Because you're stuck at a very strong level of resistance. So you need to make sure that you're clear of these resistance levels. If we go, look at this, guys. I'm going to go to Bristol Myers. It's one of my favorite examples to show people. Bristol Myers this is zoomed out. This is zoomed out to 2016. 2016 here, and that same line is here, and here, and here. Did it peak over? Yeah, it peaked over, but what did it do? It kept coming back to this consistent line, 2015. Look at that. This is 2022, this is 2023, and it did not get there in 2024. But you can see, you need to make sure that you are clear of these resistance lines. If we draw another line across here, look at this. Completely just getting obliterated, cannot break through that level. Does it break through the level? Yeah, it does, but for how long? Make sure that you're not buying into resistance points. Same thing goes for going on the way down. Then you want to look for your patterns. Look for your 50% rules that are out there. Look for your head and shoulders that are out there. This, to me, I'm looking at this on Bristol Myers right now. This is a nasty ugly face that's being formed. What happens with ugly faces? Boom, they usually come down. This gap is probably going to fill. A gap happens on earnings typically when the stock price jumps up, closes here. Let's say it closes here at 4 o'clock. The next day at 9:30, it opens up here. That forms a gap. Gaps usually fill. I say always fill. Gaps usually fill. You can see this one. Jumped up, gapped up, all the way back down. The gap filled. You're going to see that with a lot of stocks out there. So this to me is an ugly face pattern. I would actually watch how this one develops. Earnings. We've talked about earnings. Pay attention to your earnings, guys. TradingView gives you a great tool in saying when earnings are, what the earnings expectations are going to be. Their next earnings report on Bristol Myers is February 6th. It tells you it's going to be in the morning. That's what the sun is for. Morning of February 6th. Every stock out there, as long as they're reporting it, has when their next earnings is going to be. Put it in your calendar, put it in your phone, do whatever you got to do to not be in a stock during earnings. January 30th, 2025, that's Apple's next earnings date. It's going to be 4:30 in the afternoon, just like it always is. But you got to know when your earnings are. So when it comes to checklist, take this checklist, take those, 8 things that I just told you, write them down, and do not deviate from them. You will be better off for it. All right, so you see that I use TradingView. So TradingView to me is the best platform out there for the masses. Anybody can access it. You can pay for more data if you want to. For me, I pay for a different profile. That's why I have different layouts on my screen. I have real-time data. I think I can have 4 screens on at one time. There's so much different stuff that you can do here with TradingView. It's incredibly customizable, the most customizable out there. Now, I made a video where I ranked other trading platforms. Thinkorswim was one of them. I think I went through Charles Schwab. Maybe Webull was one of them. I don't remember what they were, but there's so many trading platforms out there. To me, this is the best one for the masses. And right now, you can actually go in and, just like I showed you in the beginning, the chart setup, you can 100% replicate my chart right away and start off with it. And then you can upgrade as you need to as time goes on. But TradingView is a fantastic platform just to get yourself started and to be synced up with me and the other people in the community. And just so you guys know, I have no affiliation with any trading platform. Doesn't matter to me what you use. If you want to go off on some other platform and try to replicate my chart, you're more than welcome to. I get nothing from TradingView. So you're welcome, TradingView. So let's talk about the psychology of trading. I've mentioned it a couple of times. Trading is it's a unique place to be. Really, anything with money is unique when you really think about it. So when you go and invest in your first stock or whatever, you are probably checking your phone constantly to see what the stock price is doing. It's different than anything else you do. If you go invest in a business, you buy a house, you invest in whatever, I don't know, that doesn't have a ticker symbol on it where it's not moving constantly, it's not that hard. You might wonder, hey, what's my business worth today? Hey, what's my house worth today? And you could take a pretty good guess, maybe, but there's not a dollar amount that's changing every single second. I'm looking at Apple right now. I own Apple stock. $232.19. Just sitting there. Now it's $232.20. And as the seconds tick by, I can watch this thing change in price. $232.21. Very good chance that it pulls 19 cents, 20 cents, 19 cents. You see this? That can cause people a lot of emotional turmoil. 23 cents now. I'm happy it's making money. You need to be able to sit there and say, okay, I need to look at this as patterns, not as dollar amounts going up and down. For me, when I look at a trade, for example, I don't look at the dollar amount that I made. I look more at the percentage that I made. Why? That's what's important in the long run. So who is trading for? I'm going to kind of loop two things together. Who is trading for? I really say that it's for anybody because this is a skill that you're going to use for the rest of your life. You might have $50 now, right? Well, eventually you're going to have 50,000. Eventually you're going to have 250,000. Eventually you're going to have 500,000. Do you really want to try to learn this when you have a lot of money that you could possibly go in and just risk? Or do you want to learn a skill now that you can hit the ground running when you start to accumulate more money? For me, it's the latter. I want to be able to learn a skill, and as I accumulate more money, it just becomes easier. It's also going to help you on the emotional side because you're going to know, well, it's going to be the same thing when I'm trading with $50 in a stock versus $50,000 in a stock. Why? Because it's just the pattern. And by the time you start trading with $50 in a stock to $50,000, at that point, you're going to be so comfortable. For example, every trade that I make right now, especially when it comes to a swing trade or a long-term trade, is just $100,000 into a trade. So when you see the videos that say I made 17,000, whatever it is, it's 17%. That's what it is. It's the same amount into anything, but it doesn't matter. If I put in $10,000 into a trade, $1 million into a trade, whatever it is, the trade is the trade. It's the pattern. It doesn't make me any more nervous or loose or lax depending on the dollar amount. All I'm focused on is the pattern. And when the pattern develops, I'm going to be rewarded. And if I end up losing a little bit, which I have, which you have to accept that you are going to lose. That's another big piece of this emotional puzzle. You have to accept that you are going to lose money. But you're losers if you follow the rules, if you don't deviate, if you trust the trend, if you do the same thing over and over and over again because it works, you are going to lose less money and your winners are going to far outperform your losers. Why? Because you have stops in place, you know where to exit, you know where certain support levels are, etc. The emotional toll that this can take on people is a lot. And if you go back to 2020, 2021, people were in the market and they got completely wiped out and they said trading doesn't work. Well, no, trading doesn't work if you're just going to follow price moving up and down and what some pundit's going to say on television or what somebody on Reddit's going to tell you. Yeah, it's not going to work. 100% it's not going to work. But if you have a process behind it, it should calm your emotions a little bit. Repeat the process over and over. Now, something else for handling emotions with trading. Start with paper trading. Do not jump in with real money off the bat. What is paper trading? You can go to something like an Interactive Brokers. You could do it here on TradingView. You can do it on an Excel sheet if you want to. And let's say I'm just going to pick a number here. Okay, so Apple is Let's ignore stochastic here. Actually, let's pull up the daily chart. Oh, okay. Well, it's not going to be the greatest example because I'm just flying through it. But let's say that this was an engulfing candlestick today, right? Okay, I'm going to buy it here at 232.30. Be honest with yourself that you were actually buying at 232.30. Don't fudge the numbers. Don't go in and say, well, I would have bought at 232.25 just so you can make an extra 5 cents a share. No, you got to be honest with yourself. You have to be honest with yourself where you would make your real entry points, where you would make your exit points. That's why I don't really love the Excel sheet. There's so many great programs out there that you can do it. But if you start trading with paper, you're going to realize you're going to see those dollar amounts going up and down every day. It might make it a little bit easier when it comes to trading real money. So when it comes to emotions, then there's one big piece to the end. Surrounding yourself with people that are in the same boat with you, okay? You need to be able, it's a very, very lonely road out there if you do it yourself. Thankfully, you have me. You can ask me questions and whatnot. But it's a great place to be because other people can help you control your emotions. They can validate you. They can tell you that you did something incorrectly. They can help fix it for you. Paper trade, that's going to help with your emotions. And then just get comfortable with focusing on patterns and percentages. Don't focus on dollar amounts going up and down. I know that kind of sounds hard to do, but once you do it, it's going to make your life so much easier and you're going to become a better trader when you do it. So you have your emotions handled and now you have a lot of time on your hands. Maybe you have a full-time job, but you can supplement. Maybe you work from home and you can trade a little bit. How do you become a profitable part-time trader? Whether that's day trading, swing trading, long-term trading. It's kind of great because that part-time profitable trader can kind of work in different areas. So if you're the person that maybe you work 3 days a week and you work 2 days a week at home, 3 days a week in the office, and you can actually day trade on those 2 days a week. And that's what you want to do. Or you're the person that has a full-time job and you are just completely swamped. You have kids, but you can long-term trade because I showed you it really doesn't take much time to long-term trade. Well, there, you're a profitable long-term part-time trader. So you can kind of tailor this to wherever you want to go as far as what method of trading you want to use. So how do you become that? Well, number one, you're going to need capital. So at some point, you're going to need capital if you're going to want to really supplement some type of income. There are so many people in the community. I've been doing this for 3-4 years, teaching people online. We had a guy. His name's Gianni. I don't think he'll mind me telling him. He worked in healthcare space, and he came in and learned how to day trade. And I think that he made 3 times the amount of money that he made at his actual career job in just day trading. And he's phenomenal. He's the best day trader I have ever seen. He's absolutely fantastic. He's actually showed me things that I taught you today that helped so much, and he picked up these little things. Just a fantastic trader. We have other people that have come in and they're just fixated on swing trading. This is all they do. They have a certain number of hours per week outside of their normal careers that they just continuously execute swing trades. I have another friend of mine who he's a chiropractor out in Sacramento. Found me on YouTube, started getting into trading. Now he sees patients twice a week and trades 3 times a week. He was actually able to reduce his schedule from 5 times a week in the clinic down to 2 times a week in the clinic, which I said to him, I was like, are you ever going to retire from this, from being a chiropractor? He's like, no, I absolutely love it, but I don't want to do it 5 days a week. I want to do it 2 days a week, and then I want to trade the rest of the time. And that's what he's doing. He's doing a fantastic job. So there are these real stories of people that came out and they found themselves as average people that have never seen a chart before. And now they are doing this as a part-time career. It is very possible. Guys, we all started in the same place. Myself, for example, I started trading. First time I ever saw a chart, I was 14 years old. All right. I was sitting in the computer lab up at my high school. I was a freshman. And they gave us this stock market game. And to this day, I wish I could remember what the game was. I think it was on Yahoo, but I cannot remember. Yahoo was totally different back then than it was today. It's gone through different ownerships. But I think it was on Yahoo. And they gave us a certain dollar amount of fake money. And they said, go and buy stocks. And everybody, of course, went out there and started buying their own stocks of companies that they liked, et cetera. And I started reading about it, and I started seeing these charts and looking at these different patterns. And at the time, and still to this day, I have a problem with authority. And I was like, I do not want to work for some boss. I just don't. I would love to have my own business one day, not work for somebody, not be told what I have to do. Well, my dad gave me $500 to go and trade. He said, oh, you're actually pretty good at this. Gave me $500. I made some money. And I went back and I said, can I have more money? He said, no, you can't. So I had to go and get a job. I worked at a golf course, but I took everything that I had and I just started dumping it into the stock market and trading. And the money just doubled and doubled and doubled. And I was realizing these different patterns that you could find. And you didn't have to sit. You didn't have to go to work. You can sit at a desk. You didn't have to listen to some dickhead boss, which I absolutely hated. And that is kind of where my background in trading and being that part-time trader started. Then I went to school, ended up applying to medical school, got accepted to medical school. And during that time, medical school is quite expensive. So I still traded my way through medical school. 2 years. After 2 years, I realized that the healthcare system in the United States is absolutely a total joke. I wanted nothing a part of it. And I dropped out right after my second year of medical school. This, to me, is now my entire career. This is what I do. This is what I've been doing for years and years and years. But you notice here, I was able to supplement it when I was a kid. I was able to supplement it when I was busy in medical school. And now I just do it full time. And I've been doing it full time for quite a while. But you can see here, guys, you can fit this into your schedule. If I was able to fit it into my schedule, you are able to fit it into your schedule. And if you follow these rules that I have somewhat developed, I had a mentor. I had a mentor in this. I was driving down the road one day. I heard this guy talking on the radio. I reached out to him. We became friends. We're still friends to this day. That was, man, 15, 16, 17 years ago. But the best way of doing this is to have a mentor. Have somebody that's been in the game for a long time. This guy is an absolute master that taught me how to trade, that really solidified my trading. And now to this day, he'll look at me and he's like, man, you're better than me at this point. You just really get it. And it's just repetition. It's absolutely just repetition. There's nothing that I'm doing that was completely different than my mentor, but I could be that mentor to you. And that's the important part about this. So if you've made it through this entire video, I recommend you watch it again. Go back to the different chapters. Go see the things that you didn't understand, or better yet, just watch the whole video in its entirety again. Every single time that you watch this video, you are going to find something different. You're going to hear something different. We have a guy who's been in the community for about 4 years. He literally watches this video, the trading series, which is really the chaptered parts of the trading of the charts, every single week, because he's picking up different things. And he is trading nonstop. He's doing a great job, but he's always picking up these little tidbits. There's things that people will say today where I'm like, oh man, I forgot about that. I got to go review that. And I go watch my own video to just see it and just get that repetition over and over. So if you're serious, if you're really serious about this and you want to make this a part-time career, a great hobby, a supplement to your income, teach your kids, what have you, join the community. It's a great community to be a part of. This is a very lonely road to go and do it on your own. I told you about the mentor that I had. I could not have done this without my mentor. Let me be the mentor to you. Join the community. You're absolutely going to love it. And this is a skill that you are going to have for the rest of your life. Thank you guys for watching. I invite you to watch my latest video, subscribe to the channel, and I'll see you next time.